Right, so it's easy to theorize about what happens when we get to that place.
She always goes back to pain in the market.
Pain.
We just had the mother of all
Hey,
Januaries.
let's be clear.
Time began.
Chairman Powell used that word himself in Jackson Hole. He said you can expect pain, and jobless claims are at 186,000. Now, if you'd asked me back in August where claims would be as we kicked off February, Tom, I'm not sure I would have said in and around 200K.
You know, Tom, you are correct. There is a big distinction between a softening and pain. We are seeing the softening without the pain. What happens when we see the pain? And that's my point. Can we get away without seeing
Tom Constant was right, though. It's a process. I think we talk about this as if it's an event.
And that's
it's
been
a
his
process.
heritage.
And to Dom's point, you can have what looks like a soft landing, and that could turn into a hard landing based on how far this Fed goes.
Which was the reason why I thought what Seth Carpenter yesterday of Morgan Stanley had to say was so interesting. They think the Fed's going to be cutting by the end of the year, the very end of the year, because the numbers are going to turn so quickly. It's slowly and then all at once with respect to jobless claims, with respect to job creation.
We use these fancy phrases. We'll use them again this afternoon. Cumulative tightening. No one has any idea what kind of lag there is between rate hikes and what kind of damage it will do down the road. No one has any idea.
Can I talk about something un-American?
Please do.
What kind of beer?
Budweiser is the official beer of the Premier League. Is that true?
Money talks, doesn't it?
It's actually incredibly American.
If you tell me that's true, Tom, I kind of believe you.
I'm sitting at Tots Stadium. I'm with the Tots.
It was a huge controversy.
Beavertown. I mean, Beavertown has a soul. It's Robert Plant's son. It's got character.
Wait, are you just sitting over there doing research on beer?
Why do you think you knew nothing about the ECB tomorrow?
You walk into the Tots Stadium, they're playing Adele. They're playing Adele, and
you love that, don't you?
Yeah.
You love that.
You know, that's what they do.
I think there's something very special.
Man City,
there's something very special about the start of a Premier League football game just before the music's playing.
It is. It was very.
The atmosphere,
I observed that. Yeah,
the
it was
fans
very
singing.
Cool.
It's very special. It's not like basketball when they have to pretend there's an atmosphere, so they play music really loudly and hire a DJ.
Hey, watch it.
You know when they, what I mean? They hire a DJ and it's like great atmosphere. Everybody's like they're instructing the audience what to do.
It's like a bar mitzvah.
Like through the whole thing. Like there's music in the game.
I'm sitting there with a suit and bow tie, and I got 10,000 people looking at me like, who the hell is this?
I'm told we got to go. It's a smart decision. Futures are down. This is Bloomberg.
Lisa's right. It is like a bar mitzvah. Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Well, Federal Reserve policymakers plan to hammer home the message that their work in fighting inflation isn't done. They're expected to raise interest rates by 25 basis points at the end of their two-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table while leaning against bets the Fed will cut later this year. Former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, the former president raised less than $10 million after he announced that he's running, and that's seen as a disappointing haul. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt, with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
The biggest risk to markets is that we don't get a recession in 2023. The wage growth stays high, and the Fed, having maybe paused for a bit in March, then in the second half of the year, they actually end up putting rates up by more than is forecast and aren't able to deliver the rate cuts that the market's expecting for 2024.
That's the risk for a lot of people. So that's Mike Ballard, JP Morgan Asset Management. I'll catch up with Bob Michael of JP Morgan a little bit later, and he's going to talk about the same thing, that maybe this might be the penultimate hike of this quarter, but not of this year, because Lisa, he thinks there's a real risk that they could end prematurely and start to hike again near year end.
Which is actually on the margins becoming a groundswell of an idea that perhaps we're getting some sort of situation, just like you said. They get inflation down to 4, then it's sticky, and then there are signs that it starts coming back and it gets the Fed concerned.
I've got no idea. I'd just love to play these conversations at year end and see what they sound like relative to what the data looks like. I go back to what I said earlier. We're going to be talking about that phrase, cumulative tightening, and it makes people sound smart, but ultimately, what does it mean? We've just got no idea what the actions of last year will do to the economic data in our future. Zero. Look at what it's done so far. If you'd asked someone back in the summer what the data would look like in the first quarter of 23, would they have described the labour market as things stand with unemployment at 3.5% and claims where they are?
Would you describe this market as being tight? Would you describe this market as having real fear in it? And that's another question, right? Has the tightening been transacted through the market?
Sure.
Through what's going on with price action?
Well, certainly, Tom, we've got an easing of financial conditions over the last month that has undone some of that tightening.
There's no question. To me, that is the metric, and I'm really thrilled in the financial media, John. It's not they're picking it up from us, but everybody's picking up this idea of some financial conditions, and the fact is they've gone the wrong direction for a Powell trying to be restrictive. Constant says inflation is dropping so fast, he uses his phrase super restrictive, which is interesting to say at least. Okay, we got to do a surveillance correction here, and I was confused. Snap is a tech company? Like
you knew this. Yeah, you knew this.
Snap-on Tools, Kenosha, Wisconsin. And I mean, I'm sorry, there's a difference here. Snap-on Tools, Kenosha, Wisconsin, 12,000 bodies, 16% per year for the last 10 years. 16% for the last 10 years, per year. Snap, which is the world of Mandeep Singh, over the last, I don't know, 5-6 years or whatever, -6%. I don't get it. Mandeep Singh, is Snap a tech stock? I mean, I just don't get this underperformance and this worship of these companies. Do they have any chance at Snap of being a profitable company someday, like Snap-on?
Well, so I think two things here. One is the environment we are in right now. Inflation, we were talking about it before, is having an impact on digital ad spending, for sure. Every company out there is pulling back on their sales and marketing spend, and that is trickling down to pretty much every vendor out there. It may not impact Alphabet, Google Search as much as it did Snapchat or Pinterest or the smaller guys, but you can see that every company feels advertising is discretionary, and that's what they're pulling back on. And look, Snap is a single product company. It's a one app company. I do think they can be profitable because they have 370 million daily active users. Tell me how many apps out there have that kind of scale in terms of daily active users? Probably 5 or 6. And so because they have the engagement, I do think it's a monetization problem, as is the case with some other apps. And over time, they did very well for 2 years during the pandemic. 2020 and 2021, they grew over 50%. So they have a growth problem right now, but I think they can be profitable if they keep their user engagement at this level.
Mandeep, because of time, I'm going to go to Facebook. Pre-pandemic, they did $21 billion in free cash flow. They've basically have that. Has Facebook seen their best days?
I think in their case, yes, because they are losing engagement. And I go back to engagement because ultimately in the internet world, you don't have a very long life if you can't keep user engagement. And there will be something new, generative AI or something else that will be better. And Facebook can make any acquisitions right now. I mean, they bought WhatsApp and Instagram at just about the perfect time to add to their business. Well, guess what? Right now, the regulatory environment is against them. So I do think their best days are behind, but at the same time, they can improve their free cash flow once the cyclical downturn in ads kind of improves.
Mandeep, there was a huge question emerging from Snap's earnings yesterday about whether Apple's security policies that went into effect a little bit ago have, in effect, killed some of the advertising model of Snap and Meta.
Absolutely, and I think all these companies are redesigning their ad stack. So the good thing for Snap, and I think we're going to hear from Meta as well, is they are able to leverage their first-party data. I mean, previously they were tracking all kinds of activities outside their apps for ad targeting. But now they are able to improve their ad targeting based on just the data within their app. And it's still better than, what you see on linear TV. So digital ads will always have that advantage in terms of ad targeting that linear TV doesn't have. And I do think it's a work in progress. It's not going to take a couple of quarters. It will probably take longer. But these companies are redesigning their ad stacks as a result of Apple's privacy changes.
Mandeep, Tom asked a really good question about whether this is a tech company, and you started talking about some of the potential software and different programs that they could potentially come up with. But are we seeing a bifurcation into companies that perhaps use tech, which is most of corporate America by the end of 2025, versus the true technology companies where their core is some of the new and more advanced technologies?
Well, so look at the amount of data that these companies are generating in terms of the app usage and everything that they're collecting, and then they're leveraging AI and machine learning for ad targeting. So these are all the cutting-edge technologies that are currently around us. They're using a lot of computing capacity, and I do think I will put them in the tech bucket. They have a monetization problem, unlike the software companies, which have a recurring subscription model, and that's why, you see the volatility in their stocks and their growth rates.
Tremendous volatility in Snap, at least. Anyway, Mandeep, thank you, sir. Mandeep Singh there of Bloomberg. Snap is down more than 15% in the pre-market. Meta, Facebook, a little softer in sympathy here, going into earnings after the close. Facebook down by about 1.26%, Tom.
I mean, Mandeep has prodigious skills within the industry. He brings real industry cred. But all of the Mandeeps out there, they've really never enjoyed where money costs something. It's incorrect. It's not. It's always been free. It's always felt like it's been free. And that's changing.
But it's not just that, Tom. It's not just that. We had this massive pull forward, huge pull forward in demand. And we talked a long time, Lisa, about these companies being immune to the cycle, having these really strong secular growth stories, which would continue forever. Now I think there's a challenge to the latter. A real challenge to the latter. And on the former, on the cyclical immunity, I'll say this about some of these names, and I've said this before. I think a lot of people agree with this. Some of these names in their current form have never had a cyclical challenge. They've never had that before because the pandemic did not equal that at all for these names.
And Snap is the perfect example for that, with the first ever expected quarterly decline in revenue. That gives you a sense, at least reported, because they did go public in 2017, but this points to exactly what you're saying. They haven't encountered anything other than growth. What happens now? How do they adapt and adjust at a time,
part
especially,
of the great zombie roll-up?
Well, especially at a time when social media is moving so quickly? Can they move towards some kind of metaverse that isn't necessarily taking off for Facebook in the way that they hope?
What's the debate in the Bramo household? What's it sound like?
Okay, well, we were discussing whether Snap had any lasting power, and it really is the critical mass of the social use that ultimately determines its efficacy, because if people are using it for a tool to find each other and to, track each other and then have Snap, I don't really get why people do this.
They track each other.
Well, yeah, then they say, oh, he's there. Oh my gosh, all my friends are there. Why are they all together and not with me? And then they start
that sounds dreadful.
And, yeah, that's welcome to high school.
What's the difference between TikTok and Snap, seriously?
Oh, it's totally different. I mean, I don't know. TikTok.
I love this. This is great.
Do you actually like
this? Is great.
No, TikTok is more videos. Snap is actually like snaps, and I think they disappear. I'm not an expert,
but they right?
I think that's the key.
Do you remember when you'd go to meet up with your friends, and if they didn't show up, you'd have to find a payphone and call their house?
Oh, I'd go to their houses.
Yeah, well, you'd just show up.
I would show up.
Right. You'd show up, you'd bang the door down. Where is
everyone?
Aren't you?
Yeah. Well, I was the person.
First girlfriend John had, everybody else was throwing little pebbles against the windows. He threw a brick through the window.
I'm not going there. That never happened. Christian Muller-Glissman's coming up from Goldman Sachs. Looking forward to that conversation. That never happened. People believe some of TK's stories sometimes. Snapchat's down about 15 or 16%. Meta coming up after the close. Look out for that. And then over the next couple of days, just a phenomenal amount of earnings. What have we got? Apple, Amazon, Alphabet. To round out big tech. Looking forward to it. Futures down a third on the S&P. Live from New York on Fed Decision Day. Ton of economic data as well coming up this morning. Stay tuned for that. This is Bloomberg.
Growth forecasts are increasing and inflation is falling. Will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that this is something that many business leaders are focused on, and time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power.
This is Bloomberg. The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority.
The Fed wants to see real yields higher, really to make sure inflation is down and stays down for a while.
The Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with.
There are a lot of structural forces at play that are not going to bring us back to 0% or almost no inflation.
They're going to be very careful about signaling that they're ready to pause and cut
before they know it's the right time.
What the Fed does matters, and it matters a lot for the global economy.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The Federal Reserve decision coming up this afternoon. Live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures are negative about 1/3% on the S&P TK as we kick off the month of February. Are we looking for 25 from this Federal Reserve?
Well, it's a big mystery this afternoon. We'll kick it off with Richard Clarida, some other great guests. I'm really looking forward to talking to Priya Misra with that great inversion call, the re-inversion we saw yesterday under 70 beeps. Right now, negative 71 beeps. And, you know, I think it's a great set of guests to set up the optionality now, but what will Chairman Powell say about his choices, his degrees of freedom out 2 and 3 meetings out? That's a mystery.
And Lisa, will he push back against the easing of financial conditions we've seen over the last month?
And perhaps the way he could do that is to talk about indicators that he's watching that show greater inflation than others. There was a story about supercore inflation, and this is the new hot metric that the Fed is looking at that strips out a couple of things that are actually going down and looks a little bit hotter than others. So, you know, there are ways that they could try to tweak it, but will the markets actually listen?
Apollo's Torsten Slok, he writes the following this morning. He's just published. He says, Tom, it is continuing to look like a soft landing. He said that ECI wage inflation is coming down. The consensus is expecting non-farm payrolls on Friday to come in at 190,000. And he said none of the indicators the MBER recession committee normally looks at suggest that we are in a recession at the moment.
Yeah, and what's so important here, John, is the basic idea of what is the history of disinflation. And as a generalization, it's largely what's called stochastic, which is when it moves, it keeps moving lower, and that's how you get to the repeated 3% inflation calls by some respected houses.
The problem you've got is that the MBER might look at one thing after the fact to look back and say, yes, that's what it was. The market's looking at another. Yield curve inversion, PMI sub 50. That's the tug of war right now.
So what are the specific indicators that people are going to get a sense of to know that they're right or wrong? Because right now people have a lot of conviction in their bet against the Fed. And to me, the employment cost index yesterday was telling. The fact that markets moved so much to this idea that the employment costs weren't going up as quickly as they previously thought perhaps points to the power of jobs.
That powered the S&P yesterday, that's for sure. The S&P 500 closing higher by almost 1.5%. This morning, good morning to you. Equity futures look a little something like this. We're down 1/3% on the S&P. Yields are coming in a couple of basis points on a 10-year, 348.64. And euro dollar firmer by 1/4% at 108.91. Looking for the Fed to go 25 potentially today. Tom, maybe they surprise and go 50, but we're looking for the ECB to go 50 tomorrow.
And the combination, I think, is important, John. It's a statement by central bankers of what we're going to hear. The one common feature here is, let's go Latin, ex ante, ex post. By definition, they're after the fact. And I think Chairman Powell, going back to Jackson Hole in an 8-minute speech, I think they were switching your blanket. I don't know if you got the whole speech at that time, John, but the basic...
that was cold that morning, don't you?
The basic, he's back? What do you mean he's back? We're not ready. But the answer is, if it's an 8-minute press conference, it's all going to be the same, which he's going to say, we have to wait for the data, including Jobs Day on Friday. Can you imagine if Jobs Day shows disinflation?
True. You do what you always do when we're outside in the cold. You steal the heater. Lisa can confirm that. Bramo, TK always steals the heater. Never mind the blanket.
You mean like the 2 heaters, just sort of
like
facing
Stanley Fisher
or just kind of struggling?
Moves it towards him.
Stanley Fisher, IMF giant, I believe still now at BlackRock. Professor Fisher taught me that trick.
Just kick it to
Stanley
your
Fisher at Davos. Get the foot out. Stanley Fisher needs the heat.
Adam Posen had a unique view on it by just wearing a short sleeve shirt.
There's photos to prove it.
38-degree weather. Today, here's what we're looking at. ISM manufacturing data comes out for the month of January, and then JOLTS job openings for December. Manufacturing has been bleeding softer for potentially the 5th consecutive read. Do we start to see an ongoing weakening, an ongoing deepening in the contraction there? But the job openings is what I'm watching. Do you see a softening in the labor market? It starts to come through in a leading indicator, not a lagging one. At 2 p.m., we get the FOMC rate decision, followed by a 2:30 p.m. press conference by Fed Chair Jay Powell. We will be speaking with some incredible guests, including Fed Vice Chair Richard Clarida, Priya Misra, we've been talking about with the yield curve inversion discussion, Diane Swank of KPMG, and Greg Davis of the Vanguard Group. And then aftermarket, Meta reports earnings. To me, this is going to take on a new importance, particularly because it builds on what we saw from Snap. This concern about the first negative revenue growth that we've seen in Snap's history. Do we see Meta struggle with some of the same issues, John? And how much is this a read on the broader economy with respect to ad spending versus an idiosyncratic model that, as you've said, hasn't really faced this kind of cyclical downturn for its industry?
Is it a company problem, an industry problem, or an economy problem? And I think a lot of people think it's definitely one, it's definitely two, and it's probably three as well, Tom, as we look for economic growth to soften through the rest of this year.
Well, the real growth is going to be something that's going to soften through the year. I think everyone agrees on that. That's where we talk, John, about this domestic final sales, which takes a lot of the trade noise out and the inventory dynamics out. But even if inflation comes down, that gives you a nominal GDP to keep it going. Does Europe have that same animal spirit, that same nominal GDP?
Let's keep this conversation going. Joining us now, Christian Muller-Glissman, the Managing Director for Portfolio Strategy over at Goldman Sachs. Christian, a simple one for you. Are you expecting Chairman Powell to deliver a little bit of pushback later on this afternoon?
Yeah, I mean, it's a good question. I think you mentioned it earlier already. It feels like the data has been quite supportive and you're making progress. I think the wage inflation is coming in, the services inflation is coming in. I think you are on track for a soft landing. Certainly markets are shifting in this direction. So it seems to be like everything is on track. So we expect him to reiterate the message he has given before. We expect 3 more 25 basis point hikes and probably a relatively balanced meeting. You mentioned it earlier. To me, the macro data will be much more important. I think the central banks are probably a bit in stay the course mode.
Christian, we talked to the head of the Norwegian Sovereign Wealth Fund yesterday, who's got an immense challenge moving the needle because of his mass, his size. Many of us don't have that problem. Do we want to be index-based or more choosy, skew to a lower R-squared, more actively managed?
Listen, I think, as you know, in the last cycle, it was fine to be in indices. I think the market cap weights were in your favor, both in global indices, with the US being the largest market, and within the US, with tech being the largest weight. And what we've been saying for some time is that in the next few years, stock picking will get more important, not the same sector leadership, not the same style leadership, and not the same regional leadership. So it means you have to be a bit more active.
Christian, looking forward, I know Goldman Sachs has the view that oil prices are going to go up. What trade does that challenge that we saw really in vogue during the month of January?
Yeah, I mean, like, it's the big conundrum. Everybody's starting to believe the soft landing is happening and China is reopening and Europe is avoiding the energy crisis and the recession as a result. But the oil price hasn't moved. And I think it's in my kind of category of good news becomes bad news risks, because both rates haven't really followed in the optimism and the commodity prices, in particular oil. So if they start following, it further cements that kind of growth is fine narrative. And that eventually means that good news might become bad news because central banks have to react. So I think the reason why oil hasn't reacted as much might be related again to the winter because of less gas to oil substitution and because there's probably still a lot of kind of oil floating around with regards to Russian oil, which is being discounted. But I think net, it's been a big lag.
Christian, would you then lean against this long euro trade that we've seen, long European equities trade that has really dominated all of January?
I think generally we prefer non-US versus US markets for all kinds of reasons. I mean, non-US equities are cheaper. There's more runway economically. There's more slack. So you have like a European manufacturing slowdown. You have exposure to China. So I think generally it feels like Europe had a bit of a better asymmetry, both from a valuation point of view and where you are in terms of growth. There's more room to improve. The challenge you have now is the repricing has been incredibly fast. So if you look at risk premia credit, like European credit versus US credit, cyclicals versus defensives in Europe compared to the rest of the world, and also the equity risk premium, you've taken out a lot of that discount in a short period of time. I think momentum can continue to be positive, and risk premia are seldom a good market timing tool. Like short term, you always want to follow momentum, and in the more medium term, valuations and asymmetry matter more. So in the near term, we're reasonably constructive on Europe.
Just quickly, Christian, how far do you think this ECB takes interest rates?
So we have determined a rate at 3.25, and that's 2 more 50 bips and then another 25 bips hike. And I mean, it's already quite amazing where we have gotten to considering from negative rates. But I think the fact, what we're learning here everywhere in the world is that we're not as addicted to low rates as we thought. There is a certain ability to deal with higher rates. And we know that in Europe, that historically has always been a bigger question mark because of sovereign debt concerns. And we'll have to see how that kind of comes back. But as of now, Italian BTP spreads have come in, and you are in this positive growth momentum phase. So I think 3.25 is the base case, and depending on inflation normalization, of course, there's kind of risks to both sides.
The deposit rate right now, 2%, maybe 125 basis points still to go. Wow. Christian, thank you. Christian Muller-Glissman there of Goldman Sachs. To Christian's point, and I think we're all in agreement around the table on this, surprised by how well the Eurozone and European markets specifically have dealt with this.
Brief us on the Italian spread, AC Milan to Juventus. I mean, how's it going?
Yeah, I can't give you that spread
okay,
right now.
But give us
Juve's got its own problems. That's a relative story. Milan better than Juve in absolute terms, both dreadful, okay?
Give us thank you. Give us the Italian spread story. Oh, I love pushing the buttons.
You want me to talk about Italy?
Italy spreads.
I'll bring up the Italian spread
Christian
right now.
said it's a good story, right?
The 10-year, the fact that 10 years at about 4.24, and we're not talking about 6% and a repeat of the Eurozone debt crisis, is good news.
Yes.
It's good news because if you'd asked me again a year or so ago, they're going to do what they're going to do, QT on top of that, I wouldn't have been talking about 4%. I'd be talking about a whole lot more.
Can we come back and talk about the Apple performing stock nobody talks about?
What's
it's
that?
A mystery. I'm not going to, it's a secret. You have to come
You've
back
got a
and see
secret
it.
stock.
It's a secret.
Stay tuned.
Sounds like financial news from the 90s.
These people get no love, and they've done better than Apple.
Up next, there's secret stock.
Secret stock.
I can't wait. Wrong network, Tom. Futures down 0.25% on the S&P. This is Bloomberg.
That's a tease for you. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Federal Reserve are expected to moderate interest rate increases again. The Fed is wrapping up its two-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table while leaning against bets the central bank will cut later this year. Inflation in the Eurozone slowed down more than expected in January. Last month's reading came in at 8.5%. Now that suggests there will be a more heated debate to come at the European Central Bank over how much more interest rates should rise. The UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools and crippling the nation's rail network. They're demanding pay hikes to offset the cost of living crisis. Investors hurt last week by the malfunction at the New York Stock Exchange are trying to get their money back. But Bloomberg has learned that claims are likely to exceed the liability pool that covers losses, and those losses could total in the millions of dollars. And the crisis of confidence plaguing Madani is getting worse. The stock sell-off triggered by Hindenburg Research's fraud allegations has erased more than $93 billion in his value from his companies. Now, the rout has cost Adani his position as Asia's richest person. He's been replaced by Reliance Industries chairman Mukesh Ambani. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
strikes. Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Fed is expected to dial back to a 25 basis point hike.
They want to make sure they don't go too far.
Pivotal moment to make some decisions.
But will they go so far as to signal a pause?
We have a long ways to go.
Trust Bloomberg for the fastest coverage and exclusive analysis, including former Fed Vice Chair Richard Clarida.
Recession fears are tangible.
What's the mistake this year? Doing too little or doing too much?
Stay tuned. This is going to be with us for a while.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg, your global business authority.
In order to avoid the hard landing, you need to scurry very fast to get back to neutral, which we think, and the Fed certainly still thinks, is around 2.5%. And that's the story for 2024. This isn't a choice of soft versus hard landing. It's a soft landing until it becomes a hard landing. And that's why the Fed needs to be very alert to that reversal in policy.
And that's why the Fed is in such a tricky position. That was Dominic Constant, the head of macro strategy at Mizuho Americas in the last hour or so. Just a fantastic conversation there. It's a soft landing until it's a hard landing, and they've got to balance two risks, the risk of doing too little versus the risk of doing too much. And you have to imagine, Tom, those two risks have come into balance a little bit more over the last couple of months.
I think they have since the last meeting, absolutely. And just the news of the last day, the separation of, John, you follow this more than I do, is a generalization, hard data versus soft data. There's a pretty wide gap right now in the information we're getting from those two groups.
But I think the market is responding to the incoming information.
Yes.
ECI softer, inflation's coming in a little bit. We've got a sub 50 PMI. That's what the market is adjusting to. What it doubts, and I think this is the difference between the Federal Reserve and markets right now. If I go back to that Kashkari blog from early January, Neil Kashkari believes there are 3 steps to all of this. In fact, we're going into the second step. The second phase of all of this is to pause against a backdrop of inflation disinflating. They just want to stay there. They want to stay there and make sure this is gone and gone for good. And that's where the doubt is. People just don't believe they're going to get there and stay there.
My problem is people are looking at the data, and the data is coming in the soft, as you were saying, Tom. The soft data is sort of showing a very different picture than the hard data. You can pick whatever data point you want and make your own narrative, and that is the problem. So where data does the Fed focus in on to understand what backdrop they really have?
We get a lot of data today. Is JOLTS more important than ISM? John, I'm sort of with you in that ISM sort of gets out front of where we are. It's sub 50, prices paid. I mean, manufacturing.
Let's make it simple if we can. Do you believe the inflation problems of the last few years were mainly supply side or demand side? And if you believe they are demand side driven, then that labor market should make you nervous. And if they believe it is, and I think they do believe that it is demand side driven, there is an element of that at least, it's not all supply side, then that labor market will make them nervous. Claims at 186,000, unemployment at 3.5%, will tell them that this job is not done, which is why we keep hearing that phrase, the job is not done. And I imagine that's what we're going to hear a little bit later.
And I'm guessing that JOLTS won't sway them in any way because we're still seeing more than one job, more than almost 2 jobs, open jobs for every unemployed American.
That's the dream. You get JOLTS down, job openings down, and
everything
unemployment doesn't have to come up too much, and it's all perfect.
Yeah.
Wages soften.
That's what I'm worried about.
You're worried about what?
Just
Wages
kidding.
softening?
Yeah, everything perfect.
Is it that time of year?
I'm worried about Anne Marie standing up and leading the set. Joining us now in Washington, listening to this, Anne Marie Horton, our Bloomberg Washington correspondent. Anne Marie, we talked in the previous hour about this really important meeting of the Speaker of the House and of Mr. Biden as well. I want to digress here because we're going to talk about T-Mobile here in a minute on the regulatory tone in Washington. The miracle of T-Mobile, which we'll get to, is they really just ignored all the regulation garbage in Washington and delivered a superior product. Do you get the tone forward this year that the Biden administration is racing towards more regulation, more of a blanketing of what industry can do?
Well, today he'll be meeting with his competition counsel, Biden, a number of aides, as well as cabinet members. And one part of that, besides this credit card fee issue that they plan to announce, they want to decrease that fee from $30 to $8, and they think this is going to save consumers billions of dollars, is they're also looking at the application market. So when you go into the Android app, I think it's called Google something. I have an iPhone, so that one is just your app store. They think that there's not enough competition there. But this is not new. The previous Congress, there was a bill that was advanced about more competition in this marketplace on a Senate panel. It just didn't get to the Senate floor for a vote. So this today is really about shedding light on that and asking Congress to act on.
But for those of us that are fossils that remember the day the government walked away from suing Microsoft, it's political. Do the Republicans have a stark difference from the Democrats, or are they all on the same page of going after big tech?
I think there's nuances in it, but it is fair to say that there is moments and levels of bipartisanship when it comes to concerns each party has when it comes to big tech. But sometimes those concerns always don't match up and they don't line up, especially when you look at the likes of the social media companies when it comes to Meta or when it comes to Twitter. There's big concerns, but they differ on each side.
Meanwhile, we see the Biden administration kind of towing both lines. On one hand, trying to cater to some of the further left side of the party with certain consumer demands. But on the other hand, there was a story about the Biden administration actually providing support for the drilling project of ConocoPhillips in Alaska, which goes against also some of the left side of the party, particularly the green side. How much pushback is he getting inside the Democratic Party?
Well, the progressives and the environmentalists are certainly not happy about this announcement, but what we have seen over the course of the past 2 years from this administration is they've had to really pivot when it comes to energy policy. This was a president who, remember, called Saudi Arabia pariah and then had to make a trip there when gasoline prices were flirting with $5 a gallon and then head north of that. So this is, I think, a recognition of the administration that while they have an aim to want to electrify the grid and change the energy landscape, that it is in a transition. And maybe it's not as far ahead of a transition as many on the left wing of the party had hoped it to be. So they really have no choice, though, right? Because there's sanctions against Russia. There's a number of issues at play in terms of the energy landscape. So when deals come ahead, they're going to have to, with some of them, give their okay, even if it means upsetting the progressive wing of the party. But remember, also, midterm elections are over. He's done a lot the last 2 years for the progressive wing. So this is just really a reality check.
AMH, down in DC, great to catch up.
Regulation.
We're taking the show down to Miami with everyone else. I promised you this data about an hour ago. I can bring it to you now. Net migration, net domestic migration, California.
Yeah.
Year-over-year change, California, negative 0.3%. New York, negative 0.9%. Illinois, negative 0.8%. Where they're going, we know, Florida, plus 1.9%. Texas, plus 1.6% year-over-year change, Tom. Real numbers they are.
These are real numbers, and why do we think it's a one-off? I'm hearing conversation to conversation, anecdote to anecdote. Wow.
I always thought it was the weather. The naive foreigner in me would come over here and always thought it was the weather. And then I realized, Tom, it was more than just the weather. It's taxes too.
A little bit more to
and a whole lot more than that.
Humility's in order here, folks. I can line up the times I've been wrong. I tell you, John, this is a really important thing. Study, study, study when you fail. It's not my biggest failure. My biggest failure was thinking Lula would blow up Brazil. I was wrong. The bottom line is my second biggest failure was the guy with a pink T-shirt. T-Mobile, in the last 10 years, out with earnings today, has outperformed Apple Computer, fractionally. But they're up 24.3% per year. Their free cash flow build, John, from pre-pandemic is an act of God, and they have flattened the competition, including Verizon, which is flat free cash flow from 2019.
Did you judge him because he wore a magenta T-shirt.
Yes, and I told him that. I told him. I met with Legier, and I said, I just want you to know, other than Lula, you're the single guy I've most been wrong on in my career. This is an undertold story. Full disclosure, I have 7 phone lines with T-Mobile, including vet bill and kennel fee. But the bottom line, John, is you study your mistakes. And this is my biggest market mistake in 10 years, was not climbing on T-Mobile.
You know, there's some talk about him maybe being the one that should run Twitter.
Oh, I didn't know that. Really? Oh,
wow.
I've heard his name thrown around.
Well,
Yeah,
can you
not heard
imagine?
that?
You know,
This is not exclusive reporting. Just for that.
But to me, I just wonder.
It's not very exclusive.
The egos. Do you
We
think
need more
Elon
breaking
Musk
news here. Come on,
and that
John.
man, those egos together would actually do okay?
I saw it out there on Twitter, people talking about it. You know, people say this is who should run it and blah, blah, blah.
Should and will.
Yeah, very different things, as we know.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. You know, I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, you know, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, you know, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, you know, it's very different, and it's not something people have had to operate in for a long time.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You ever notice that? People are just, they're stockpiling toilet paper.
It's
Is that
called a hoarding,
Hoarding,
and
okay.
it's one of those things you never want to be without.
Live from a snowy New York City this morning. Good morning to you. Mike McKee informs me the Central Park has recorded the first measurable snowfall of the season, Tom. This morning, 1/2 inch. There you go.
So late. Not very much. I mean, the fact
So
that we've
late.
been
How
talking
dare
about
it?
that.
How
I
dare
know,
it
it should
come
have
so
come earlier. It should have.
Have you seen the temperature for this weekend?
It's going to get very cold for like a day.
Like legit cold.
Yeah, legit.
I would agree.
Like American.
Like 5 degrees.
Jackson Hole was
Like
0
we're not going to argue
yesterday.
about whether it's cold or not. It's
No,
like
it's
freezing.
0, and it was going to be 3, and then it was going to be 8, it was going to be 12, but this is back to 1869. You know, I'm not smart enough to know if it's global warming or whatever, but I can certainly say, Lisa, you mentioned
clearly
this.
not warm.
There's changed behavior in New York without the slush, without the snow. You know, it's a different winter.
It's less difficult to get up in the morning when it's not freezing, to get out from under your blankets. And so I think it makes January go faster. That's my theory.
That's your theory on why January went so good.
That's correct.
Okay, wonderful. Here's the price action for you.
Please.
On the S&P. We'll leave that there. On the S&P right now, we are negative 0.2%. Things went fast for the bulls because they were so good in the month of January. The Nasdaq 100 last month up by 10.6%, best month since July 22. The S&P was up 6% last month. The Euro Stoxx 50 in Europe up almost 10%, best month again since November 2020. That was vaccine time back in November 2020. What a run we saw last month, Tom.
To me, what's important here, and this is off Ralph Kampora's statement that October was the low, the Bloomberg Total Return Bond Index is up 7.8%, 32% annualized, which defeats the idea you can't make money in bonds, granted off a horrific 2022.
Let's talk about the bond market. 2s, 10s and 30s look a little something like this going into the Federal Reserve decision this afternoon. Your 2 years close to 420. It's been hanging out at this level for the last couple of weeks, but I think the interesting point here is the Fed is pushing towards 5%. Not there yet, maybe in the meeting after this one, but the 2 year is still at 420. The 10-year is at 350, and that is the yield curve inversion we face. Fed funds out to 2s, Lisa, Fed funds out to 10s and beyond.
Yeah, when will the market either reckon to what the Fed is saying or the other way around? I want to just give you a couple of names because this is earnings season and the moves are telling of the divergent fates of different corporate scenarios. AMD, when we talk about the chip makers, AMD actually came out with better than feared results and their shares are being rewarded in pre-market trading up 3.5%. Western Digital, the exact opposite story and down 4%. So just to give you a sense how even in the same industry, you can really get the winners and the losers. A very difficult time to come up with some sort of generality for all of the market action that we're seeing. When you take a look at some of the tech names, Snap, we've been talking a lot about, those shares lower by about 15% after they forecast the first drop in revenue in their public existence. What this means for Meta, a big question, although people are not wasting time. They are selling, and those shares did lower by nearly 1%. But all of the tech shares have gained so much this year. How much has this just basically taken some chips off the table just in case, rather than some sort of wholesale repudiation? Match, though, just to give you a sense of some of the companies that have grown up over the past 5-10 years. This is the dating app that doesn't see any material improvement in its business model going forward. Those shares down more than 8%. How many other companies are there like that have existed because of a very benign environment and monetary situation that are now going to have to reckon with perhaps a very different reality?
And Meta as well, 2 names which have commoditized people.
I'd say a lot more as commoditized people, but let's move on.
Just going to throw that out there. Are we done?
Are you done, Lisa?
We're so done, TK.
She didn't mention Peloton. I mean, she wrote the headline for the Peloton people. Peloton, thanks Mark Gurman for this, our ace on Apple. Look for Mark Gurman tomorrow. Peloton no longer at, quote, brink of extinction. His loss is narrow. Now that's a Bramo headline. That's a Bramo headline.
They're still in a spiral of doom.
Extinction.
That's fantastic.
It's a relative game in markets, isn't it?
Yes, exactly. So
Is that better than expected?
I have no clue. Ask Mark Gurman. Mark Gurman tomorrow on Apple, Bloomberg with our world-class coverage there that we'll see. Right now, and this is important, a bond update to get to the Fed meeting today. Robert Tipp joins as Chief Investment Strategist at PGIM. Robert, I was going to do a real yield analysis, but John Farrow on the data check nails it with a 2-year yield. Where should the 2-year yield be now, or where is it heading to off of Fed action, 4.19%?
Yeah, I think there's a message in that inversion out to the 2-year note. I think that 2-year yield could be headed a little bit higher. You know, I think the Fed has been very steady on their anti-inflation message. Could get a little bit of upward pressure here on yields in the near term. The markets are screaming, though, and even the Fed's indicators for recession, which would be that first 18 months of the yield curve are inverted, are screaming for them to stop. And in 2018, they did one more hike than they kind of needed to. They're probably going to do one or two more hikes than they need to this time. But everything is coming together for what's a really kind of a weird bull market compared to what we're used to seeing. But as you highlighted, Tom, the returns are starting to come in and have a long way to go.
Robert, why is the bond market right and the Fed wrong?
The bond market has, fear and greed operating. And what we saw in 2022 and off the yield lows in 2020 was the fear side of it. The market saw the inflation like they'd never seen it before, and then they saw growth come screaming back. And the markets, went to an extreme all around the world, not just in the US, in Europe, Australia, every place, even Japan, to get ahead of those central bank rate hikes and this aggressive fight on inflation. Now, frankly, they're ahead of the curve. Everything that was supposed to happen is happening in spades. The growth is moderating really around the world, but in the US as well. It's still a very solid backdrop, I would argue. We're going to have rolling unrecessions where people are surprised that you don't have serious downside problems, but it's moderating. And the inflation numbers are coming down in spades. They had another negative print in Europe. Your core ex-shelter in the US, kind of a real center of that inflation, the sticky part you would be worried about, has been negative for 3 months. Commodity prices are down. Everything is coming together. So I think the market, short term could be a little bit jarred by the fact that the Fed is still on the roll here. But everything's coming together for them to hike one or two more times and to be done.
Robert, let's talk about what John was bringing up, the concern that let's say they do pause. Let's say the Fed gets what they want and they stop in March. And then inflation doesn't go down much further. It stops at 4%, even 3.5%, but does not continue to disinflate. What then does the Fed do?
Right, they're going to hold, right? And I think that is going to be what's going to happen. I think headline inflation is going to come down more rapidly because commodity prices have come down rapidly. A lot of goods prices got really elevated. It's easy for them to drop off a bit. But I think your below target inflation that we've had around the world, I think that was kind of a one-time fluke, a lot of competition coming on the heels of the financial crisis. We may stay a bit above target. I think the markets may be wrong about that. And so this bull market is not going to be big profits coming from yields having a huge tumble. This is going to be a bull market that stems mostly from yields getting high, and they have gotten high across the curve and staying high.
Is there follow through here? It's been a lovely January, a nice fixed income bounce. Do we break out to a new regime or do we churn?
Yeah, I mean, when you look across fixed income sectors, your yields, on your general market, whether it's investment grade or below investment grade, they're back up to 2002 levels. So the clock has been turned back, to the beginning of the last phase of the prior bull market. And so you're going to have solid returns from fixed income over the next 10 years. Now, what profile that's going to take over time? Do yields go up a little bit right now as the Fed finishes their rate hike cycle? I think there could be a little bit of give back in the short term. But big picture, it is going to be a slow and steady. So a little bit slower rate of return than we saw in the first month.
But Robert, what's important here is if I have a success and I finally got the bounce after a horrific 2022, do I adjust to a shorter duration? Do I adjust to a different credit type? Or do I adjust to cash?
I think the danger for a lot of investors in the inverted yield curve environment is going to be that they do choke up. They come in on the yield curve. They do not maintain their duration. And 5 or 10 years from now, growth in aggregate is probably going to be slower than it is now. You won't have the post-COVID stimulus and enthusiasm. Inflation will be lower. Rates will be lower. And the people that are in cash or they're in bills, they will not have locked in those long-term returns. And on the off chance that inflation very quickly drops down below target and central banks actually do end up cutting along the lines of or more rapidly than what's priced into this curve, investors that have stayed short, that have not been in long-term fixed income, are going to miss out. They will have had a year or two of high yields, 5%, 4%, depending upon where they are, or 9% if they're in high yield and they don't have defaults. But it's going to be, if they're in the front end, they're going to get that 4%, and then it's going to be gone when short rates come down. If they're locking in at the back end, in high yield, in hard currency emerging markets, or long-term general fixed income, or even 1 to 10-year fixed income, that yield is going to be with them for the duration.
Robert, just quickly, how would you respond if the Fed went 50 today?
Yeah, I think economies have a lot more underlying oomph, are a lot more resilient to central bank mistakes. And 50 today would be a mistake. Honestly, personally, if I was in their shoes, I'd say, hey, we were going to hike 3 times this year, 25 basis points. Obviously, we're planning on skipping 5 out of 8 meetings. We're skipping today. We've seen ECAI, we've seen CPI, we've seen all these things. Doesn't mean that we're not going to hike more. We're just not hiking today. We told you we're going to skip meetings. We're skipping today. And then you'd end up skipping every meeting this year if things keep going the way they're going. They do 50 basis points. Given what they've seen on the inflation side, there've been head fakes. The data has been revised under their feet. It would be understandable in some sense, and it would be a recoverable error, in my opinion. But it would be, more than is needed at this point.
Robert Tiff, thank you. Diplomatic over at PGIM Fixed Income. If they skip today...
What is it about today?
If they skip today, I'd be pricing in cuts tomorrow.
A recoverable error sounds like the Red Sox strategy.
Well, him and Don Constant are very, very diplomatic, Tom, aren't they?
Little barbs kind of put in there with the same tone as everything else. It was fantastic.
McKee, stand up. Excuse me, Mr. Chairman, is today's signal a recoverable error?
It's a fascinating time where people are talking about rate cuts, potentially on a year where Chinese GDP could be 5-6%.
To me, the takeaway from that conversation is the market's right, the Fed is wrong, period, full stop.
A lot of people share that view, don't they? Wouldn't be the first time the market's been wrong, though.
That's the concern.
Yields are down a couple of basis points, 348 on a 10-year. Equities are down 0.1%. The Fed decision coming up. ADP jobs in about 30 minutes' time. We'll break that down with Mike McKee.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers plan to hammer home the message that their work in fighting inflation isn't done. They're expected to raise interest rates by 25 basis points at the end of their 2-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table, while leaning against bets that the Fed will cut later this year. Former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, the former president raised less than $10 million after he announced he's running, and that's seen as a disappointing haul. The CEO of Boeing says it's a matter of not when, but not if, but self-flying planes will come to commercial aviation. Dave Calhoun told Bloomberg TV the company's autonomous flight technology being developed for the military will eventually come to commercial jets.
As you may know, we have an application on an all-electric autonomous airplane. We refer to as WISC. And that airplane, that application is in, and the FAA will begin working with us today on building out a certification program for autonomy and for WISC.
Calhoun spoke at an event making the final delivery of Boeing's iconic 747 jumbo jet outside Seattle. The plane is a cargo version that will be flown by Atlas Air. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much the consumer is paying them. And so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value and the kind of transparency that they want.
Are you seeing a labor shortage right now? And What are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
News breaks. No one covers the world like Bloomberg.
Return to pragmatism is really that everybody's in line. The government, the enterprises, the people in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Our view coming into this quarter was not necessarily that the results were going to be all that great. It's just that expectations were so low that it just put risk reward to the upside. Expectations were low, positioning were low. So in that sort of combination, it doesn't take a whole lot to get the stocks moving higher.
That was Stuart Kaiser there of Citi, live from New York City. This is Bloomberg. Equity futures right now on the S&P, down by about 0.1%. Coming up a little bit later on this afternoon, the Federal Reserve decision is this afternoon. And in about 20 minutes, in fact, about 30 minutes, you're going to get the ADP report, then onto the ISM, job openings and all that good stuff, TK. It's a busy morning. And then after that, this afternoon, after the close, you get Meta earnings, Facebook, then onto tomorrow, Amazon, Apple, and Alphabet over the next couple of days.
We've touched on it, but I think we really have to say this is a bit of an odd meeting and that there's a substantial amount of data coming out today. And I'm going to go to the Faro indicators, which is ISM. John, tell people why ISM matters to you.
It's sub 50, and 50 is the dividing line between expansion and contraction, Tom. And contraction, sub 50 ISMs, usually you sit up and pay attention. You get another one, you pay more attention. You get a string of them, Lisa, and we've had a string of them. You should be paying a lot of attention. So it's weird. It is weird historically to have sub 50 ISMs in a Federal Reserve that's hiking, and it will be hiking today.
This is weird in a lot of ways, though, right? I mean, we've gotten this sort of rolling recession, a manufacturing recession, but a services expansion. So how do we describe weird in terms of economic policy when you have this sort of rolling economic cycle that's very hard to nail down?
Do you want something less surprising?
Yes, please.
Exxon. Okay, Exxon, no drama this morning at the pre-market. It's down about 0.25%. But the earnings beat expectations with a record $59 billion profit in the last 24 hours. So you can imagine what the feedback was like from the White House. Here's the quote. It's outrageous that Exxon has posted a new record for Western oil company profits after the American people were forced to pay such high prices at the pump amidst Putin's invasion. Tom, I think that response quite predictable after what we heard about Chevron.
Predictable, but there's a different tone in Europe. I'm fascinated, John, by the distinction here of Europe where there are windfall profit issues, and here where it's a huge debate.
Well, that's the makeup of government, right? They can execute. They can make the decision. They've done that. Tom, there are other industries that maybe we should be talking about windfall taxes. If the profits of Exxon and Chevron are the consequence of policy and war and not of innovation, I'm borrowing some words from Thatcher, forgive me, from a couple of decades ago, then obviously you might make the case that there should be a windfall tax. Now, can't you make the same argument when it comes to the pharma companies, Pfizer, Moderna? When we had mandates in some places whereby people had to go and get those vaccines, aren't those profits the consequence of policy and a pandemic out of their control?
It's a great point, and it points to the politicization of the energy industry in a way that perhaps no other has seen.
Sure. When it comes to buybacks, look, I know there's the innovation argument, and we haven't got time for that. Of course, that exists. But when it comes to buybacks, we're talking about Chevron. We're not talking about Apple.
Okay,
we're talking about margins. We're talking about Apple. We talk about Apple margins. They're huge.
The reason why we politicize this, though, is because of the backdrop of climate change and this concern, and that a lot of the energy companies themselves are coming out and saying they've got to reduce emissions. So the question is, how do you get there? And just to jawbone these companies lowers didn't work, at least not when there was some sort of disruption in the oil supplies.
But I'm far more cynical. It's about getting re-elected. It's about votes.
Right, it's political.
This is how you speak to people. And Anne-Marie nailed it a couple of weeks ago. I think it was last week when we talked about it. She said, John, you buy an iPhone once a year, you make a monthly payment, you don't really look at it. Oil at the gas pump, that's what's going to make the difference in the polls. And that's all it's really about.
Yeah, and that's what we've seen in terms of consumer spending as well.
We're going to get philosophical here and look at the broader oil policy. Regina Mayer joins us now, Global Head of Clients and Markets at KPMG. At Barely describes her hydrocarbon wisdom from Houston, Texas. Regina, I'm going to cut to the chase. Are we prepared for $100 a barrel oil?
Well, I think we've been there, right, Tom? So clearly we are prepared for it. I don't expect that we'll see that maybe in the second half of this year. We still have muted demand, but IEA is expecting that demand will grow to the highest level ever for 2023, nearly 102 million barrels per day. And while supply is still comfortably within the 5-year rolling average, what will happen when Russian supplies come off the market? What happens when Chinese demand spikes? What you talked about relative to the large traditional energy companies, their response to capital investment is going to be more muted because of the politicization that you just mentioned. So we're not going to have massive increases in supply, and we're still facing into significant hydrocarbon demand worldwide.
What do we do downstream? I think there's so much romance to the upstream debate, far less romance to downstream Houston. What about not in my backyard, and what do the big companies do about that? They're fighting massive blockage of setting up refinery, right?
Oh, absolutely. There's a not in my backyard for wind farms, for solar farms, for all kinds of investments, natural gas exploration and development. And so what we're seeing, I was actually in Davos, so share some of the macro trends that I'm paying attention to. Clean energy for the first time in 2022, dollar for dollar matched fossil fuel energy. So, but that's not going to be enough to achieve the energy transition. It needs to get to 4 to 1. Now, notice I didn't say 4 to 0. I said 4 to 1. So we still need hydrocarbon investments, and we need massive investments in clean energy and new technologies. The other word of the day was friendshoring, because the realization is the components for hydrogen investments, the electrolyzers, the solar panels, the wind turbines, a lot of that comes from China, rare earth minerals. So how do we create new supply chains to deliver the energy that we need from friendly parts of the world with a diversification strategy? And it's not just about oil, the weaponization of renewable components, politicization of all types of forms of energy, not just oil, will become a big part of the policy and the calculus that nations will have to address.
Regina, let's build on that with the question of diesel in Europe right now. There have been a lot of stockpiles of diesel ahead of a new sanction on diesel of refined Russian oil. At what point does that become a concern? Because there hasn't been enough friendshoring when it comes to diesel imports, in particular to Germany.
Well, for sure, those are some of the vulnerabilities that the war in Ukraine has exposed to the global supply chains. I'm hopeful that because we're aware and we're managing within the European continent in advance, it'll be like the success story that we have for natural gas. That is an economic success story that we don't often talk about. The European natural gas prices in September of last year were $3.50 per terawatt hour, or the way that they calculate it. It's down to 60/70, significant drop. Henry Hub is below $3 when it was at $10 in its 52-week high. I'm expecting that the European Union will pivot as successfully as they did for natural gas with diesel, and it will be part of their overall strategy as they wean themselves off of fossil fuels sooner rather than later.
Hey, Regina, this was great to catch up, as always. Regina Mayer there of KPMG. You know what, I can't believe it's almost been a year since this war started.
I think a lot of people can't believe it.
Isn't it just amazing?
It's horrific. It's
Terrible.
horrific because there's no sense of it ending. And that's what I'm really concerned about. There was a column that I was reading by a former general talking about how, in some ways, the U.S. is escalating this with respect to some of the weaponry that they're sending over because they're kind of calling Vladimir Putin's bluff that he isn't going to necessarily escalate in some sort of nuclear way. People are not worried about that in the same way, but what's the risk of this just dragging on?
Lisa, what happened to the conversation about only sending defensive equipment and being worried about escalating things? What happened to that?
It went away, which is the reason why I think it's quite interesting. This sort of question of escalation isn't more in the forefront because essentially now they're just saying, well, maybe fighter jets is a bit of an escalation, but other things not so much. So you're right. People aren't talking about that because people don't believe that the nuclear threat really is as present as it was a bit ago.
The war continues. This certainly, though, Tom, not the winter that many Europeans feared as a consequence.
Oh, yeah. Well, big drop. You look at a gallon of gas in the United States, and granted, it's not Europe and it's not the prices, John, you grew up with, but starting in February a year ago and the war and the huge spike up, we went from roughly 355, spiked up to 420, and then went higher to 502, and we've come right back down to where we were at the beginning of the war. To me, it's a behavioral thing. Regina was just on. She's a Cornell grad, and I remember in the 70s where you really thought about driving across town because it was such a shock what a gallon of gas is. And I'm fascinated if we go back to $4 a gallon or $5 a gallon, do we get the same behavior again that we knew back then?
Well, we did see that. And I think that was the takeaway from what we saw last year. There was demand destruction
SPR
once you got to the $5 mark. I mean, yes, there was the SPR release, there was that response, but you also saw demand go down. And is that going to create some sort of ceiling to how high those prices can essentially go?
We went from 130 intraday was the high print on Brent in early March. 130.
I did not know that.
Yeah.
We got up to 130 on
Got
Brent.
down to 130, yeah.
That.
The low about 70. So somewhere in the high 70s this morning, Tom. And there are some calls, Jeff Curry and others, looking for triple-digit crude again this year.
We've been China-free, Pacific Rim-free. You get demand out of Indonesia. What does that do?
Things change, clearly.
Pros say up.
Liz Young's going to join us shortly over at SoFi, counting it down to a Fed decision. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
As growth forecasts are increasing and inflation is falling, will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
No one can claim that climate change is somebody else's problem or shrug it off for future generations to address. We're all affected by a warming planet. We see that every day. And decisions being made right now will determine our shared tomorrow. So we must choose, and we must act as united nations ourselves. Our progress depends on collective action, on collective ingenuity. If we stick together, we can make fixing the climate the greatest project and greatest achievement of our lifetimes. We have the science, we have the solutions. Now all the world needs is political will. Together, we can create a future where rampant carbon is removed from the atmosphere, where green buildings and green business transform the livability of communities.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The world is in a much better place today than it was 4 or 5 months ago. A lot of the apocalyptic scenarios have gone out the window.
It's a pretty mixed picture. The inflation picture is very clear, but the growth picture is not as negative as it was 4 or 5 months ago.
Clearly, the China reopening story is the big narrative going on right now in markets.
Expectations were so low that it just put risk reward to the upside.
The biggest risk to markets is that we don't get a recession in 2023. The wage growth stays high.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A 14-hour day. We greet you this morning on radio and television and move on to the Fed decision this afternoon with Mike McKee's leadership. John Farrow, McKee in that press conference. Anything can happen.
Financial conditions, easy, front and center. That's the headline for us. We ended January, Tom, with the easiest financial conditions going back to last February. Is that a problem for Chairman Powell?
Yes.
We're going to find out in this news conference.
And also, we talked to Dominic Constamere starting off our coverage this morning, and he made clear he reaffirms this edge of super restrictive because inflation's coming in.
Is it still too early to tee up a pause? A lot of people think maybe that pause is just around the corner. Tom, in the statement, there is this quote, ongoing increases. Will that be in the statement this time around? If you really want to get in the weeds of all of this, that's where the focus for the Mike McKees of this world will be. In the statement, does that language change?
Or in the idea of cumulative, which is, I believe, not in the statement, but that's the same idea of the effect meeting to meeting.
It's in the official communication of the Federal Reserve. I think there was an argument that Vice Chair Braided maybe put it in there, Tom, in that statement. Where is the damage? Where is the damage right now? Because it's not in the labor market at 3.5% unemployment and claims at 186,000.
I'm going to go, Lisa, as simple as I can. Liz Ann Saunders pounding the table that she's following of the mix of everything today, housing dynamics. What does the chairman say about the impact of housing? What did you call it? Service sector? There's some phrase for the new service sector series.
You mean the rolling recession, the sort of question of the
core service?
Supercore. Supercore. Yeah, that's exactly it.
Supercore. That'll come up in the press conference.
I was in a band in high school called Supercore. No, but in all seriousness, there is this issue of what people are focused on, but also what the Fed wants to do. And I like that you guys both were talking about that 8-minute speech back in Jackson Hole. I think that today, the way that he could win is by giving a very short speech and then saying nothing. Because right now, there's really nothing that he could say that's going to get the market to comply with him, and he isn't going to be able to do anything good if he signals some sort of pause or some sort of easing in financial conditions.
Lisa, John outlined it earlier. The data dump between now and Friday at 8:32 is extraordinary, including earnings.
So then why should he say anything? Why not just say, look, we're still doing the same thing. I'm looking at the data.
Tough to do in the news conference.
People are going to ask.
Plus, he's actually not very good at doing it.
Correct. He always ends up saying something. What do you think, though, is going to be the main question that he's going to get that could potentially trigger some sort of reaction? I'm thinking perhaps it is about how concerned he is about the easing in financial conditions. Does that bother him?
Number one, absolutely. I couldn't agree more. That is the question. And the spread between them and the market off the back of that, because of that. How do they resolve that? But the problem is, Lisa, they can't resolve that today. They can't resolve that today with a 25 basis point hike, downshifting again.
But they could say, we are bothered by the rally. We don't like what the market has done. This goes against what we're trying to accomplish. That could potentially move the markets.
I just flat out disagree with that. I just don't think they look at the markets like that. They look at it as a sum total, which shows within the Bloomberg Financial Conditions Index shocking accommodation. I mean, the market's part of that.
I think ultimately you're both on the same
just the
page.
market.
You pose the question like this, and a journalist will do it. Have we seen an unwarranted easing of financial conditions in the last couple of months since the last Fed meeting? And you give him the floor. He knows this question's coming. So how he answers it, you can read a lot into it. He knows this is coming. He woke up this morning, looked in the mirror and practiced it. Like, this question is so
he'll have a
obviously
written out
coming.
statement.
Totally right. He's doing it right
He's
now.
gonna have-
Obviously coming.
Exactly.
He's going to have a written out statement about the social impact on a huge part of America that is flat on their back. I mean, there's a huge body of America. They're looking at people in bow ties, navel gazing recession, and they're going, are you kidding me? We've been living one.
To be clear, perhaps people are listening to that in the general population because that will be perhaps a headline. The markets don't care what he has to say about that.
Fair.
Let's be honest.
Yes.
They do not
Yes.
care. They are looking for what he's going to say about what he's going to raise rates and how much he is bothered by the easing in
We're
financial
going to dive
conditions.
into a spirited discussion on this, but we need a data check. John, I'm going to start with the accommodation on standard deviation, positive 0.326. That's not a Powell-friendly data point.
Stocks this morning lower, soft and negative, down about 0.25%, but on the year to date in the month of January, absolutely flying up 6% on the S&P, on the Nasdaq up 10 in Europe. Even more so in some places around Europe, Tom, and beyond over in China. Just a massive rally. And we have to talk about China too. I'd love to hear about China in the news conference with Chairman Powell a little bit later, how he thinks about demand picking up. Maybe he thinks maybe we get some inflation imported out of China as well. I'd be interested to see how he frames the China reopening because, Tom, you cannot make a call on the economic data without a decent idea, for the global economy anyway, without a decent idea of how this China reopening
I want to go to Richard Clarida and say off the new Blanchard effort, there are these other factors out there like demographics, technology, and such. And how blind is the Fed flying? How far are they from some conventional monetary
Do we get
theory?
that dark room analogy again? We're in a dark room, we've got to move slowly.
Yeah, probably. You know, that's what,
Socrates
that will be getting.
Socrates caves are looking
All of
for
that stuff.
reflection. Yeah, okay.
Let's get some clarity. Liz Young joins us now. She's been on fire on Twitter. She's been a real value add out on Elon Musk's Twitter. She's head of investment strategy at SoFi and joins us now. You saved the best part, Liz, for the bottom of your research note. I love it. If it looks like a duck, walks like a duck, quacks like a duck, you're saying, look, this is not flamingo, it's not ostrich, it's a duck, and we're going to slow down. What is the evidence you see that there's a duck out there that says slow down?
Yeah, well, good morning, everybody. I'm glad to be here. So when you talked about it actually earlier in the hour just now, what are the indicators that are telling us things are actually getting worse? If you look at the leading indicators, or the things that we usually look to give us a signal that things are getting worse and not better, most of the leading indicators, if not all, including the Treasury market, are telling us that things are getting worse. So if you look at things like the leading economic index and its change over a 6-month period, right now that 6-month change is negative 8.2%. That level has never gotten below negative 3% without a recession to follow. You look at the yield curve inversions, not just the 2s, 10s anymore. We're looking at a 3-month 10-year inversion, the near-term forward spread, which is the Fed's indication of inversion, all inverted deeply and for a long period of time. So these are no longer questionable inversions. And then things like capacity utilization moving down for 3 months in a row, that usually precedes a recession as well. So they're indicators that we can't ignore, but I recognize that some things out there still contradict that, and there are reasons for people to stay bullish, and they're excited about this rally that we've seen in January.
I mean, Liz, I see this, and I see the theory, and it's a tight linkage here, and it's also known, of course, at NBER and in JSTOR as the Bramo-Young theory. There's no question about that. It's a little bit of caution, to say the least. How does the chairman adapt to the Bramo-Young theory today in the key bright lights of the press conference?
So here's the thing about these press conferences. Jerome Powell has not really changed his tune at all, yet the market, every single time we lead up to one of these press conferences, challenges him and says, we're sort of listening, but we're not entirely listening. So prove to us again that we should listen to what you're saying. The hiking cycle is maturing. There is no question about that. They are definitely closer to the end of it than to the beginning of it. But here's the thing about a rate hike cycle. It usually indicates that we are late cycle in the business cycle, right? That we're in the late part of the business cycle. And when we get towards the end of the rate hike cycle, that usually means that we're at the beginning of the economic cycle turning down. So this doesn't always happen at the same time. It happens in a sequence. Rate hikes, as we all know, take a while to bake into the economic data. So we're just now seeing some of that come through. We've obviously heard headlines in certain sectors. I think that there already is a recession in certain sectors of the economy, particularly in tech and in financials. So it's not something that we can deny and say everything's fine. The labor market is still strong. Yes, that's true, but only in the data that we know of. And that data is lagging by about 6 months when you look at some of the downturns that started to happen last summer and fall.
Putting the bond market aside, because perhaps the bond market is pricing in some of that slowdown, isn't the stock market disagreeing based on January's action?
Absolutely. And I think the stock market, this is what gets confusing for investors, self-included, right? You look at all of this conflicting data and say, one of them's going to be wrong, but one of them's probably going to be right. So the stock market, I think in January, traded on a number of different things. Some of them were technical. Some of them were the opposite of what happened at the end of last year. And we very quickly forgot that December was quite painful in both the NASDAQ and the S&P. So as we got really excited about a 6% rally in the S&P in January, people seemed to forget that it was down 6% in December. The NASDAQ was down 9% in December. So it's not as if we've suddenly got all of this new alpha generation. It's really just making up for the drawdown that we saw at the end of last year. But there were some other things that came into play. Inflation is moving in the right direction. Goods inflation probably moves to all-out deflation this year. And that is a good thing for consumers, and that is a good thing for input costs. The concern now is that at what point does the inflation drop actually get stuck? Will it get stuck at a level that's higher than what the Fed is comfortable with? And will it get stuck at a level that keeps the Fed hawkish or keeps rates high? How long can businesses and the economy sustain through that environment? And I think that's really the biggest risk for the rest of 2023.
It's the what if. What if we end up at 4 and we get stuck there, to Liz's point, Tom? It's a great final point. Liz, thank you. Liz Young there of SoFi, ahead of that Fed decision and ahead of the data. ADP report, 4 or 5 minutes away, Tom. The employment change, looking for 180,000 in our survey. The previous number, 235. That's the appetizer for the main event. Payrolls Friday, just around the corner. Looking for a payrolls number, 190,000 is the median estimate in our survey.
To me, that's
so far, 190.
190 is the estimate?
Yep, down from 223 in the previous
people,
month.
I believe it's JP Morgan. I can stand corrected if I'm wrong. They say we need to go under 100,000 to show we're miles from that.
That's JP Morgan, Bank of America, and Morgan Stanley all say exactly that.
Do you want Andrew Hollenhorst and his estimate over at Citi?
Please.
305,000.
No. Really?
They're going at 305. They think that we get a real bounce back in the January labour market data. Do you want the low? Intesa. Intesa Sao Paulo out of Italy, taking a guess. Throwing a dart with a blindfold on. That's everyone. That's not a jab.
50,000.
The Italian banks, they're looking for 130. So there's your range. At the moment, at least, 130 to 305. That's your low and your high.
Font of information.
Your medium, 190.
Can you imagine?
Futures.
North of 300.
1% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Policymakers at the Federal Reserve are expected to moderate interest rate increases again. The Fed is wrapping up its two-day meeting today. Chair Jerome Powell likely to keep further rate hikes on the table while leaning against bets the central bank will cut later this year. President Biden and House Speaker Kevin McCarthy meet today with the upcoming debt limit in the balance. House Republicans are demanding spending cuts. The president said he's open to fiscal reform but won't negotiate over the borrowing cap. Failure to raise the debt ceiling could lead to a default. Inflation in the Eurozone slowed down more than expected in January. Last month's reading came in at 8.5%. Now that suggests there will be a more heated debate to come at the European Central Bank over how much more interest rates should rise. The UK has been hit by its most severe day of strikes in more than a decade. As many as 475,000 union members are on strike today, closing schools and crippling the nation's rail network. They're demanding pay hikes to offset the cost of living crisis. And JP Morgan Chase is planning to open a digital bank in Germany. That will create a launch pad for the largest U.S. bank to expand in Europe. Bloomberg's learned the German bank will open late next year or early 2025. JP Morgan plans to target other EU countries after that. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays. The top names in business are on Bloomberg.
Different countries are at very different places, so you actually cannot speak in generalities. We expect to see a rolling series of country recessions, but the vulnerabilities that amplified previous recessions around the world are not present. That omens well for a mild recessions when they come.
Nobody covers business like Bloomberg, your global business authority. From the world of politics to the world of business, Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Jay Powell hates surprises and likes to stay on script. The surprise part, not possible. Everyone said 25 basis points, so there'll be no shock. I think he's got to have to put a hawkish tone. And that's the staying on script. Pause is off the table. Nobody plans to pause.
Chairman Powell just around the corner. That was Vincent Reinhardt, the chief macro economist and strategist over at Dreyfus and Mellon. Equity futures down 0.2%. Some data just moments ago. Let's get you that economic data. We can join Mike McKee down in DC. Hey, Mike.
Hey, John. Yeah, well, if Jay Powell hates surprises, I got a bad one for him here. 106,000 jobs created during the month of January, according to ADP. Now, the ADP report doesn't have a great track record. It doesn't have a long track record either since they did it last year. However, this is significantly lower than the 180,000 that had been forecast for this indicator. ADP basically blames the weather. The blizzards in the Midwest during the month of January and the big floods in California kept people off the job. Now, it's interesting because ADP looks at the whole month of employment, whereas the Labor Department looks at the pay period containing the 12th of the month. So ADP shouldn't have as much of a weather impact as the BLS does, so it does raise some questions about what we're going to see on Friday. The official consensus forecast for Bloomberg is 190,000 jobs for the BLS report on Friday. Goods-producing jobs were the big losers, which would fit with a story about the weather, with 24,000 construction jobs going away. Manufacturing increased by 23,000, according to ADP. And the only area of the country that lost jobs, the Midwest, 40,000 jobs fewer, and again, that could be the weather. So if the ADP is to be believed, January might have been a softer hiring month, but because they're talking about weather, guys, it may not be something that fits the pattern of, well, the Fed is slowing the economy.
Mike McKee, thank you. Have you got some breaking news yourself, Bramo? Tom Brady.
Yeah. No, I wasn't paying attention to that at all. Yeah, Tom Brady just announced that he's retiring in a video. So
Again,
perhaps,
just to be clear, again.
Yeah, again. So he did before, but now evidently it's not being pressured by anybody in his household, it sounds like. I'm not going to get into any of that. But
well, you just did.
Oh, but please continue.
We'll just move on,
Continue.
please. Let's just go on. Look, let's talk about the ADP. Let's talk about the market response to
gave up Giselle
it.
for that season with the Bucks.
But that's exactly what I was saying, you know?
I
assume there's more to it.
Can I just
we can never
state
get
here?
inside the bedroom.
She's doing an interview with Vanity Fair soon. So I hear.
You know,
You're tracking it just as closely.
I'm looking, and we'll get this out, folks. I'm looking at the wonderful video of Brady in a T-shirt. And Mike McKee is with us, who's really into the NFL. The Broncos had a great year. Mike McKee, he looks exactly like the kid out of Michigan nobody believed in a million years ago.
Well, he has worked very hard to stay in shape, which is why he could keep playing at 45 years old. I think he looks a lot better than you or I, Tom.
Got
Maybe
that
not
right.
as good as Bramo and John.
No, well, Bramo's got chiseled. I mean,
But there was a lot of speculation he'd keep playing because he's still in good shape.
I mean, there it is, and you know we'll get the video out. There'll be tons of coverage on this.
I still think there's
Wait,
a chance.
Can I just say, hold on a second. The fact that we're talking about Tom Brady instead of ADP is actually telling. I mean,
Why?
on one hand, because it shows the lack of importance that a lot of people put on ADP, even though we're talking about jobs data that's coming out, that's all important coming out on Friday.
We are giving the ADP report the respect it deserves.
Wow, that's harsh.
That was just, just a statement as fact. It's amazing that everyone looks at the ADP report and they're like, I don't care about it, and then they trade on
changing
the bond
it,
market.
and
You're to lower
I'm
by
going
2
to
basis
defend
points. Tom.
ADP that they're figuring it out, and they're going. Mike McKee, help me here. They're going back to their countable paycheck ability at automatic data processing. They're not doing economics now. They're really looking at the data. What does the data say, Mike?
Well, the data says that we're seeing a slowdown in hiring, and it gets down, you were talking just before the break, gets down to about that 100,000 level, which would be the replacement level, the level of jobs you need created each month to absorb new entrants. But if this is just weather, then one would expect a snapback in February, and so it's hard to divine whether it's telling us anything about the future course of the economy or not. You're right. They do say they're trying to focus on how many jobs were created and not massage the numbers. Should mention they also do payroll now, and the people who stay on the job saw their pay increase 7.3% during the month. That doesn't show the kind of progress that the Fed would be looking for.
There is some indication from this data, even if it is distorted by weather, in terms of the services bifurcation with the manufacturing side of things. And you have seen that divergence continue. Has there been any precedent for this, a sort of rolling recession in manufacturing without the rest of the economy following on? And I say that ahead of the ISM here at 10 a.m.
Yeah, you go back to 2015-16, there was definitely a manufacturing recession in the U.S., particularly in the oil patch, and it didn't translate into the rest of the economy, but we did see a significant slowdown at that time. So it has happened before, and it is interesting that so far the Fed's raised interest rates 450 basis points, and unemployment has actually only gone down.
Let's stay on theme. Tom Brady, quits rate later. Mike, in all seriousness, I love that data point when we get the jobs report. It's the quits rate, because ultimately, if you feel confident about the economy we're in, you quit your job because you think we can get another one. And Mike, that quits rate actually picked up in the last month. Are you looking for the same again?
Well, it's hard to say because it was a holiday month. When you're talking about December, you're talking about periods when people may not be focused on their job as much, but it'll be interesting to see. The other thing we want to see is the job openings number, because, of course, Jay Powell has hung the Fed's strategy on that. The idea that there are so many open jobs in the country that we don't have to have a big rise in unemployment or necessarily a recession to bring down inflation. People can just get the open jobs that there are.
Mike McKee, wonderful, as always. Looking ahead to payrolls on Friday.
Brady analysis.
And the data a little bit later.
McKinney's gifted.
The ADP report, 106,000, Tom. The estimate, 180. The previous number, a revised 253.
With his prestige, a year ago, I believe he darkened the door at Manchester United, and there was this huge uproar. I mean, and particularly after his Bitcoin debacle, which I have no personal knowledge on, but this is a guy that needs to attach himself to the tots. I mean, there's
you think so?
Yeah, him and Harry Kane bonding, loving kisses, and taking equity interest.
No, I think there's a relationship between the Bucks and Manchester United and the Glazers and all that
Yeah,
stuff.
I get all that, but I mean, this is
What would
something...
you like to see him do for Spurs?
just show them the excellence. Look, he's the most underrated. This guy was the most I remember clearly, who is this guy? No one cared about this guy from Michigan. And in the pantheon of this, and the persistency of his excellence, there's no one.
Do you think he's actually retired?
Yes.
You think this is the one?
In the video, yeah.
I knew that that's what you were hinting at when you said, I love the quits rate because it should suggest confidence that you can get another job
that's between the lines.
Equally high paying. So I looked at Indeed.com for the highest paying sports jobs. He could become a sports editor. He could make $36,000 a year.
That's the highest paid job.
Baseball coach, $39,000 a year. No, in all seriousness.
To be a baseball coach, you only get that much. Where's that?
That says,
Little League.
I think that this is probably
ninth grade.
That's not Yankees money.
I'm guessing this is not Yankees. Sports reporter, $40,000 a year. Just some suggestions for Tom Brady.
Okay, that you think Tom Brady's going to take one of those jobs? Hasn't he got a TV gig lined up at Fox?
I'm sure.
With some serious money.
I have no doubt.
Tom, have you seen that contract?
Yeah.
We're talking like real money.
Yeah.
Never mind 40,000, hundreds of millions.
Harry Kane worships Tom Brady. He really patterned his career.
That's actually true.
By his thing.
He is a big fan.
You bring Brady over, you reach, and this is with Mr. Conte, very sick with gallbladder surgery today. But I mean, come on, Brady can add a certain luster there. You could get Brady, Gareth, the whole group there to reignite the, what are they, 5th place tots?
Okay.
Connection lost.
I've got the control room in my ear saying we're losing audience by the second. So I just want to come
It's
back.
a lovely video. I'm sorry. It's a lovely video.
Coming up in the next hour on the markets, not on the NFL or Tom Brady, Bob Michael of JP Morgan, Kathy Jones of Charles Schwab.
Oh, very nice.
On the equity market, Mike Wilson of Morgan Stanley, Chris Harvey of Wells Fargo. That's your next 60 minutes on Bloomberg
Jerome
TV.
Powell may get a question today on Brady.
On Brady?
Yeah, sure. Why not?
Okay. What
It's
do
a
you think he's
big,
going to say?
John, for America, this is a big deal.
For America.
This is a big deal. This may not be a big deal for you, but Lisa Bramos fully briefed on Brady.
He's leaving now.
When Mike McKee broke the number and we came back,
You did nice. You finessed it.
I went straight to Brady.
Yeah, you
Straight
did.
to Brady.
Yeah, you did.
You know,
And then
I
said that.
I understand the magnitude of the moment. I get it. I really do.
So you're going to leave now.
There's a part of me that just doesn't believe he's retired. I don't know.
I know. I think that you're probably right.
Give it a few months.
I think he's retired this
San Francisco.
No. I don't know.
All right.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, where did that hairdo come from, and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance on Fed Day. Please join us this afternoon. We lead with the former Vice Chairman Richard Clarida. Some good guests. Jeffrey Rosenberg scheduled to be with us, among other worthies. Diane Swank, we are thrilled, will be with us today. Right now, Lisa Bramlett and Tom Keene as John Farrell prepares for a middle and 9 o'clock hour on television as well. Right now, we're going to go with futures negative 11, a bit of a roll-off off the shock ADP data, to Michael McKee on the obscurity of his data world and the debt ceiling. Michael, what is odd at 8:30 Wall Street time?
Well, Tom, we have the latest refunding decisions from the U.S. Treasury Department, and the extraordinary measures that Treasury is taking to stay under the debt ceiling are enabling them to sell as much in terms of refunding bonds this quarter as they did in the prior quarter. The auction sizes are unchanged. They're going to sell $96 billion worth of securities next week. $67.1 billion will be to refund maturing securities, and $28.9 billion in new cash. The only way they could do that is because they're taking the extraordinary measures to stay under the debt ceiling. Auction sizes, as I mentioned, unchanged from the prior quarter, and they say it is unlikely that the debt limit will be breached before early June, but expect variability in bill and cash management bill sizes. Treasury is basically going to say, as we get closer, they tell very short-term securities so they don't run into a debt ceiling problem.
Mike, what's the so what here in terms of who buys that debt? Is it U.S. institutions? Is it the American public, or is it foreign participants?
Well, it's a mixture of all of those, and we've seen the central banks go up and down, and we have also seen the primary dealers go up and down in terms of who's buying what. So far, no indication that either the debt ceiling or any of the political problems that we've had in the United States are causing people to rethink. But we are watching countries like China to see if indeed they might cut back on their purchases of U.S. Treasuries. And then there's going to be a real question when Japan gets to the stage of deciding what to do about yield curve control. If yields go up in Japan, we might see a lot fewer Treasury purchases from the Japanese as they switch to their own country because they can get a better return. I did want to mention, Tom, in terms of the news of the day and jobs, Tom Brady, you were talking about, is going to Fox. At least he has a contract to go to Fox to be their lead analyst for $375 million over 10 years. So he is not a retiree. He's a job switcher.
Okay.
And I'm wondering if that's going to affect the job salary sizes because he's switching over.
Fantastic analysis. Michael McKee, I love it. He's talking about the denomination of what we've seen with respect to Tom Brady leaving, and it's not leaving, it's just switching. I do want to get a sense, Michael, because Tom asked this question basically, why do we care about this sort of granular inside baseball type of machinations? There is a question about whether the debt ceiling and the debate around that is going to affect the roll-off of the Fed's balance sheet, their ability to continue selling debt as they go through this year. What's the latest on that?
Well, the Fed hasn't commented, but Jay Powell will probably no doubt be asked about that this afternoon. If the debt ceiling is binding and we get to a situation where there's not enough issuance out there, that Fed could speed up sales from its balance sheet to try to provide more liquidity to the bond market, or they could just simply start buying bonds. They have said in the past they won't do that. They don't want to get in the middle of a fight between the administration and Congress. But of course, if the market seized up, they would feel obligated to do something.
Michael McKee, thank you so much. We look forward to your question to the chairman this afternoon on the career, the life of Tom Brady. Now joining us, Jerome Schneider, who's better than good in the short-term space with PIMCO as well. No, Jerome, I'm not going to ask you about Tom Brady, but I am going to ask you what we've observed through the morning. What a January bounce. I guess you could take 4, 5, 6%. And I know, Jerome, you're sitting with your Bloomberg and your Monroe Trader annualizing that out as well. What's the now what for you after a January pop?
Yeah, in reality, you know, what used to be just a handful of basis points is pretty substantial. And you're right, Tom, the annualized returns you have in a single month now add up to something, for cash, that's something in the realm of, 4.5% to 6%, depending upon your strategy. That's an important factor to consider when you look at the landscape right now that's punctuated with economic uncertainty, potential for volatility, and we're at a crossroads right now where clearly the market is at an impasse with the Federal Reserve and where they're going. And so that's going to probably be reconciled over the next couple of weeks, months, and as it is, it doesn't necessarily portray to be a smooth ride. So we do still find value within that front end of the yield space, within the global bond world. However, I think it's really the question is not necessarily where to be on the yield curve, but more importantly, it's a discussion of how much to allocate to fixed income in general, given the recalibrations we've seen.
And Jerome, what's so important here is OBE, where you're overcome by events. And here, Jerome, and I'm speaking as a total hack, people in the mid-maturity decide they want to enter the Jerome Schneider space, and you get price up, yield down, where it's no fun for you. Are you going to be overwhelmed by people running, dashing to short term?
Well, there's actually pretty much a tremendous supply of that, and I think it's sort of met on two folds. Number one, you have of course, people looking for moving from lower yielding investments now that they're aware that there is attractive options in cash, but there's also significant opportunities that persist, and it's really typically outside the traditional landscape of money market funds and T-bills. It's more in buying short-dated asset-backed securities, high-quality commercial paper, things that really have self-liquidating features, but yet remain fairly insulated to where we are in the global economic cycle. That's the key. But I do think that there is an overall focus right now where people have shunned for more than the past decade an over-allocation to bonds, and that really gets to the point right now of instead of a discussion of where on the yield curve to be, despite the discussions of where we are with the Fed today, it's more about how do you want to create a more balanced portfolio given the yield enhancement that we can see for portfolio performance more broadly.
The shift in tone, Jerome, that you have right now is telling to me, because you were one of the most popular people, I'm sure, in the investment world about 6 months ago when everyone was flooding to cash. And it was all about the appeal of cash as an income-producing instrument. Now it's fixed income is an appealing alternative to other assets, perhaps in a way that they haven't been. Does that indicate that people are moving out of cash at a really rapid pace and going into other either denominations of credit or equities?
Well, not necessarily, and I think what is still prevalent in people's mind is sort of getting a little bit stung by the third rail of volatility within the broader marketplace. People obviously don't really dismiss what happened in 2022 so quickly, and more importantly, when they see periods of risk off, there is a mindset now, even in the retail investor, to be very focused on how much volatility your portfolio is going to produce during those uncertain times. And so while people might seem opportunistic or perhaps see a softer landing given the real data we've seen over the recent past, the reality is you're not seeing that risk appetite being as pervasive as it once was, specifically because that inciting action was driven by extremely low yields. That is a factor that's recalibrated people's expectations to create a more balanced approach to how they handle risk. And again, focusing on the volatility within their portfolios, whether institutional investors or retail investors for that matter.
So if flows continued, that you have observed at least, into your funds and into the fixed income space at the same clip that they did, say, a month or 2 months ago?
Yeah, no, I think what we're seeing is sort of a pause right after the year end. People are really sort of accepting the fact that these higher yields are still here to stay. They're taking that initial step into perhaps money market funds. Some T-bill supply has come, and that's sort of being met with some initial demands. But we are seeing people utilize this as a more strategic approach. Front-dated fixed income, low duration type of strategies, things really within the 0 to 5 year part of the yield curve are really sort of giving people an opportune set to create that balance. What I think is important right now is there's a natural tension within the market, a tension which is that the market is clearly trying to forecast and get ahead of the prospective Fed cuts that might come. From a historical perspective, the market is fixated that that comes. But that's a probability-based event. And what I mean by that is that there's an uncertain action that when you look at market pricing says there's a certain probability that it will be assigned to it. It doesn't mean with 100% certainty there's cuts on the way at all. It's just a probability that it would happen. What's more important, though, is that the Federal Reserve is operating from the next chapter of that playbook from a historical perspective. And they're fully in mind that there's lasting damage from inflation. What it means for the investor is that there is going to be some reconciliation. That reconciliation isn't necessarily as painless as people might portray, even if we do get that soft landing, Tom.
Jerome, Lisa from Fargo emails in. Thanks for watching, Lisa. And she says, does a guy like Jerome Schneider care about the debt ceiling? Do you care?
Yeah. Of course we care. Of course we care. But it's a little bit too early. It's the prelude to the actual act, and not that we're forecasting any default situation, although that is a potentially remote situation that we have to be prepared for. This is not really a discussion for today or tomorrow or even March or April. It's well into the summer, and I think that we have a good playbook on how it happens. For our point of view, where we say right now is really focused not obviously say on the Fed today, but more over the next 6 weeks, where we're going to be getting frankly more important messaging from the Fed in terms of the summary of economic projections in March. And so the march toward March is really where we can see a little bit more definitive posturing in terms of the broader market impacts. The debt ceiling is not something du jour that we have to worry about, perhaps being trumped by the Tom Brady news.
Jerome Schneider, thank you so much for that comment on Mr. Brady. He is with PIMCO.
And the other comments on bonds, come on.
No, but Lisa, I think this is really, really important. We're seeing a bond market reaction. 4.19%, 2-year comes in a bit, 10-year comes in with a vengeance, 3.47. But what I'm really noting here is some substantial inversion over the last 2 days. Round it down, negative 73 basis points with a real yield coming in every more. And I look at the sum, and the one outcome no one's expecting is 2.99%. 3.99% 2-year yield. Nobody's looking for price up, yield down.
Well, in terms of actually pricing in more substantial rate cuts within the next year or so by the Federal Reserve at a time when they're saying no. What I'm struggling with here, and something that we've heard from a lot of the guests, is this dissonance between a bond market that is pricing in that softening and expecting that the Fed won't have to do that much, and a stock market that's not on the same page despite earnings, right? I mean, you could say we're just bouncing back a little bit after the sell-offs of last year, but at what point does that divergence start to create a little more discomfort among strategists?
You know, and another thing, and you've just brought this up, this from Bloomberg. Bloomberg reporting right now that Blackstone's real estate trust that Lisa was on has hit their monthly redemption limit in January. And I mean, that's a continuing story there of housing upset.
Well, and what has been priced in versus not, given that it's not a very liquid market.
For Global Wall Street, please stay tuned. Professor Abby Joseph Cohen of Columbia Business School. Good morning. This is Bloomberg Surveillance this morning and this afternoon.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve policymakers plan to hammer home the message that their work in fighting inflation isn't done. They're expected to raise interest rates by 25 basis points at the end of their 2-day meeting today. Chair Jerome Powell is likely to keep further rate hikes on the table while leaning against bets the Fed will cut later this year. Former South Carolina Governor Nikki Haley plans to announce she's running for president. She would become the first Republican to officially challenge her boss for the nomination. Haley was ambassador to the United Nations under Donald Trump. Meanwhile, the former president raised less than $10 million after he announced that he's running, and that's seen as a disappointing haul. The White House is taking aim at high credit card fees and mobile app stores. The Consumer Financial Protection Bureau will formally propose a rule to cap late payment credit card fees at $8 from an average now of roughly $30. Meanwhile, the Biden administration wants Congress to open up mobile app stores to greater competition. Thieves stole a record $3.8 billion worth of cryptocurrency in 2022. That's according to blockchain research firm Chain Analysis. Its report says that hackers linked to North Korea stole an estimated $1.7 billion last year, more than 4 times as much in 2021. And as you've heard here on Surveillance, pro football quarterback Tom Brady says he's retiring from the NFL, this time for good. In 21 seasons in the league, Brady won 7 Super Bowl championships, 6 for New England and 1 for Tampa Bay. Brady announced his retirement last year, too, but a few weeks later, he returned. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You notice that people are they're stockpiling toilet paper.
It's called hoarding, and
okay.
It's one of those things you never want to be without.
This is Bloomberg Daybreak with Lee. On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
We've actually got a house view that's a little bit dovish relative to markets. Like everybody, we expect 25 basis points at this meeting, but after that, we think they're going to be done at the Fed. The only way that happens, but we think it is the path that will happen, is if we get farm payrolls coming down well below 200 and looking like they're going to 100,000 and in fact below 100,000.
The nuances of Ellen Zentner and Seth Carpenter. They're Dr. Carpenter, the chief global economist at Morgan Stanley, on the parlor game we're going to see today. Lisa, to me, what's going to be fascinating here is what Powell reads off script. There's so many sensitivities. Does literally every question, does he look down and read that silly scripting, pretending he's not reading it? I mean, that's on radio, for those of you on radio,
so true.
It's hilarious
so
when, and Lagarde does the same thing. I mean, I'm not picking on anybody here, but the question, let me answer that as best I can, and then they read off the script.
We have decided collectively as a group. No, but I really do want to hear what he has to say about financial conditions, how much he pushes back, and whether it does bother them or whether they're okay with it because the economic data is softening enough to give them comfort.
One of the great fears of academics on the island of Manhattan this year has been to audit Professor Cohen at Columbia Business School. Joining us now as she rockets out of a term into tests and grading, Abby Joseph Cohen, of course, a nodding acquaintance with Goldman Sachs and professor at Columbia Business School. Are you enjoying it, Abby? I mean, is this like a whole new life for you where you're gonna be there till you're emeritus? I mean, is that where we're heading?
Good morning, Tom, and good morning, Lisa. I'm having a great time at Columbia. The students are absolutely wonderful. About half of them are from outside the United States. and they're all extraordinarily well prepared. Most of them have worked before they've come to business school, and so these are people who are really committed and focused on what they're doing.
Let us talk about a paper you did. I don't know if you dragged it out for your students and punished them, CFA Institute, where you brought some Greek philosophy to Columbia Business School. And what Aristotle suggested in your iconic paper is get off the wagon of believing every data point. Tell us what's suspect right now. What's the humility we and the chairman have to bring to scanning every tea leaf?
Fabulous question and a very timely one, Tom. Right now, I think there's so much focus on U.S. data among U.S. investors. We have to recognize that the Fed is also looking internationally, and they're looking at the trends there, both with regard to economic growth and inflation. And then, of course, there are the concerns about what happens to the data in China. People don't quite trust those data. And so when we turn our attention back to the U.S., it's our employment data. But today alone, we're going to be getting the JOLTS data, which will be a very important element of what we look at. And of course, the employment cost index information, which is critical. When I think about what I worry about most right now, in terms of too much instant analysis, it would be the company reports. We're in the middle of earnings reporting season, and what we know from history is that in periods when the market has been down, companies will take a look at those fourth quarter results and say, you know what? Let's take some reserves. Let's throw in the kitchen sink. It clears the slate and gives them a lower base from which to work for the subsequent year. So I wouldn't read too much into the fourth quarter results, particularly when they seem to be throwing in all kinds of disappointments that they knew about for a long time. And I'm much more focused on economic activity going forward.
Have we priced out free money from equity valuations, Abby?
To a very large extent. We saw that happening during the course of 2022, Lisa, when we saw PEs in general going down, but the segments of the market, not just in the United States, but outside as well, were basically the high beta, fast growing areas that really depended on low interest rates. For the low discount rate, it gave the valuation. So, we saw it here in technology stocks, other growth areas, but we also saw it in emerging markets, particularly in the first half of last year. And by the time we got to the third quarter, I think that investors were looking at this revaluation, let's call it the devaluation of some of these growth areas, and saying there may be some opportunities there. It's one of the reasons we have seen some of these non-U.S. markets outperforming the U.S. market, even though our market has been doing quite well. And of course, we've now seen some movement back in to the fast growing companies here in the U.S.
When we teach this segment, when you teach this segment in history, talking about zero rates, even negative rates for more than a decade, at least in Europe, and the unwinding of it, ending with a whimper. Can you write the book that it was successful, that this economy extricated itself from these low rate policies without a financial collapse?
We don't know yet, but clearly it looks like we are moving in that direction. And here I do have concerns because we don't yet know what the results were in 2022 for lots of the very leveraged products, including private equity. We don't quite know what the impact will be on the economy of the reduction in capital available to venture investments and so on. And I also think that some active managers who were okay but not great, who levered up their results, so they turned a dime into a quarter as they reported to their clients. We don't yet know what the full extent of the damage is.
Abby, what I think is so important here, and it goes to the body of your work, we just all enjoyed the carnage of 2022, whether it was 60-40 or SPACs, you name it, all the stuff that was invented at Columbia Business School. Abby, we've all got to regroup, and the hallmark of Joseph Cohen analysis is you've got to be in the game. I want you to talk now to the people that are all cash or near all cash, or even in bonds away from the equity markets. Speak to them right now.
Well, many of the individual investors, of course, have to consider other things like their tax situation, their risk tolerance, and so on. All of my work, Tom, as you know, has been focused in on institutional investors. And I think that we have seen this revaluation of assets in 2022 that makes me far more comfortable than I was, say, 9 or 10 months ago. For bonds 15 to 18 months ago, when I thought bonds were incredibly overpriced, that is, yields were too low. And we've now seen a very significant change. The Fed, like everyone else, I assume, will be doing a small increase this year. But most of what they're going to be doing, I think, has now occurred. They might do a little bit more, but after we've already seen 6 extremely large rate increases, most of the damage has occurred to bonds. So that looks like there are opportunities.
Well, Abby, I'm running out of time.
And of course, the revaluation in equities makes them more appealing than they were a year ago.
I got to squeeze this in, Abby. It's so important. The risk-free rate is back. Taleb says we've got gravity back in the system. How do the zombie companies, the never-been profitable companies, weak free cash flow companies, how do they work out in 2023?
I think there will be failures. I also think that good private equity investors may see opportunities, but I also think that M&A activity, strategic M&A from successful companies, will be taking a look at some of these operating assets and figure out ways that they can acquire and improve the underlying margins. What I worry about in terms of going through the year really is the potential for the debt crisis, the debt ceiling crisis to become real. And the reason I'm worried about it is I take a look at some of the people in the Republican Party who've publicly stated they think it's okay if the U.S. goes into default. That to me suggests a big problem. And the meeting I'll be watching today, in addition to the FOMC, is the meeting at the White House between President Biden and Speaker McCarthy.
Abby, thank you so much. Professor Joseph Cohen at the Columbia Business School. She's going into her grade. She's, I think, like Roach. Roach went to Yale. He's brutal. He gave out a couple C's, and there was basically a protest.
What she said there was fascinating on many fronts. This idea that we've already priced out free money in stocks, giving it a sort of more equal feel in terms of risk and reward and an ability to actually look at what companies are doing rather than just financial policy. But then on a broader scale, the question mark around some of the less liquid areas. And you mentioned that BlackRock real estate fund and this question of redemptions and what happens when you do start getting the same kind of reckoning in some of these less liquid areas.
I can't say enough how this return to a rate structure and rate regime affects everyone away from the obvious financial markets. I think it's...
And so we haven't seen it in every single one, and that was her point, and I think it's a really good one.
You ready for 1:30?
I am. We get to see each other again.
From Columbia, Professor Clarida will join us at 1:30 as well to begin a wonderful, wonderful set of hours. The Fed decides. Look for that this afternoon. We'll be speaking with Jerome Powell. Good morning.
No, he won't.
News breaks. No one covers the world like Bloomberg.
The return to pragmatism is really that everybody's in line. The government, the enterprises, the people in pushing this economy. It's like a cycle of renewal.
Big tech layoffs rolling in. Spotify, the latest to tighten its belt with plans to cut 6% of its employees.
Is the economy unfolding as you thought it would?
I think the economy is responding to work that the Federal Reserve is doing.
Bloomberg, your global business authority.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can if you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Make it very transparent to the shopper before they accept an order, what the order is going to look like, how much we're going to pay them, and how much like the consumer is paying them, and so they can decide whether they take an order or whether they refuse it. And that's the kind of flexibility that our shoppers really value, and the kind of transparency that they want.
Are you seeing a labor shortage right now, and what are you doing to combat that?
It's different in different places. Our demographic of shoppers is completely different from food delivery and ride sharing. We're 70% women and half of them are moms. And that's because a lot of the job at Instacart is very different than just being in a car with strangers. It's about like going to the store, doing a good job of customer service, of really picking the right products for the consumer. And we are seeing that being very appealing to women.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Live from New York City this morning. Good morning, good morning. The week begins today. The Fed decision just around the corner. Equity futures down 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Fed Chair Jay Powell set to downshift once again. ADP jobs data coming in cold ahead of payrolls, and Meta reporting earnings after the close. We begin with the big issue, the Fed's next move.
A very important meeting for the Fed.
We are expecting a downshift in the pace of hikes to 25 basis points.
The rhetoric, I think, stays on the hawkish side.
The market's got a little bit ahead of itself.
Let's just see how the Fed responds.
Chair Powell is going to push back aggressively.
Powell is very likely to remind the market that the Fed's plan is to stay hawkish.
The Fed is hawkish, but they're sort of reiterating a message that the market's already kind of gotten comfortable with.
The market is trying to call the Fed's bluff.
The Fed has lost a lot of credibility. Let's face the facts.
The statement and the press conference will be very important.
The rhetoric, I think, stays on the hawkish side.
Those animal spirits are not what the Fed wants to be encouraging.
I would expect that he would push back against these financial conditions. Actions are going to have to speak louder than words.
Fantastic lineup for you this hour. It starts with JP Morgan's Bob Michael and Kathy Jones at Charles Schwab. And Kathy, first to you. Thank you for being with us today. 25 or 50 from this Fed today, and why?
25. I think the evidence of slowing inflation pressures and the slowing in the economy in certain areas, manufacturing in particular, is enough to create the reasoning for a downshift to 25 basis points. It also gives them some optionality in terms of the next set of rate hikes. If they go 50 now, that might have sealed in more tightening than they're ready to do at this stage of the game. So 25 seems reasonable. I do agree with a lot of the previous opinions. They probably try and make it a hawkish 25, indicating they're still going further, but no reason to go 50 at this stage.
Bob, I'll be very careful about how I frame this question. Is this going to be the penultimate hike of this quarter or of this cycle?
It's certainly the penultimate hike of this quarter. We think they'll do 25. They're going to be very frustrated by the way markets have rallied and financial conditions have eased. So they're going to be hawkish. We think they'll come back in March and do another 25. Then they have to pick a spot to pause and wait for the long and variable, the cumulative and lagged impacts of 475 basis points of tightening, what that does to the economy. And if it doesn't do enough, for sure, they're going to have to come back at the end of the year. So when I think of tales of, Are they doing too much or too little? I think the bigger tale is they might actually be doing too little.
So let's discuss that tale. Bob, how high do you think the bar is to return later this year and start hiking again?
Well, I wonder what happens if they get into year end and their summary of economic projections are right, that unemployment is up at 4.5%, but you still have inflation at the core rate of 3.5%. They'll have failed on both mandates, and I don't think they can just let you get away with a higher inflation environment, so they will have to come back. And I think there's a lot of arguments to be worried. One, and we'll know more on Friday, the labor market is very tight. You have very low unemployment, and employment is rising at a pretty good clip. Secondly, you've got China reopening. You've got a population the size of the US and Europe put together, suddenly getting out and spending. Then there's the whole energy front. We all got away with a warm winter. What happens when we get into the summer? People are driving around. What if it's a hot summer and people are cooling their homes? How much consumption is there? And when do you build the strategic petroleum reserve? But I guess the biggest thing for us that we worry about is the accumulated excess savings. It's sitting on the balance sheet of businesses, households, and state and local governments. And just maybe between March and September, it absorbs the higher price levels. In a tight labor market, you just start the next leg higher. So those are some of the things that are starting to worry us about year end.
This is the ultimate what if question, Kathy, so let's explore it. What if inflation settles down at 4%? I get it, we've peaked, we're coming down, but coming down to what?
Yeah, I'm not really in the camp that says it's going to prove to be that sticky. We're already seeing a downshift in personal consumption expenditures. We're seeing consumers push back against higher prices. We all know the China story, China reopening story. It's not seemingly getting priced in right now. Energy story, same story. Everybody keeps talking about $100 and $200 a barrel oil, and yet the market's forward looking and not pricing much of that in. So I think a lot of this has already been absorbed by the market. But then you have to look at that cumulative tightening that's taken place, not just in the U.S. but around the world, and the slowing consumption data that we're already seeing. I think we'll probably see slower employment numbers. So I'm less inclined to say we're going to get stuck at 4%. Now, if we do, obviously, then the Fed has to get a lot more aggressive in hiking rates. But that doesn't seem like a high probability to us.
There is this hope that we get this soft landing. Apollo's Torsten Slok this morning put this one out, and I'll read the quote for you. It continues to look like a soft landing, he said. ECI wage inflation is coming down. The consensus is expecting non-farm payrolls on Friday to come in at 190,000, and none of the indicators the NBER Recession Committee normally looks at suggest that we are in recession. That is a judgment about where we are right now, not about where we're going. Bob Michael, you said the equation is really simple. This was your quote. Inflation doesn't come down until wages do. Wages don't come down until employment rises. Unemployment doesn't rise unless we are in recession. Bob, how aspirational is that soft landing conversation?
I think it's incredibly aspirational, and the debate for us is not whether we're going to have a recession or not. It's whether it happens at 5% or they need to go to 6%. Torsten's right, but in a bizarre kind of way, all our analysis shows that the time from the last Fed rate hike, so if March proves to be the last Fed rate hike, it takes about a year for the recession to hit. That's when the cumulative and lagged impacts happen. So in that year between the last rate hike and when the effect of the recession actually begins, there's going to be this debate. Are we in a soft landing? Will recession ever show up? Did we manage to avoid it? So all the debate that's going on right now doesn't surprise us. We shouldn't be in recession right now. It happens after the Fed has finished tightening and several quarters afterwards.
This is the ultimate debate, I think, around the economy at the moment. Unemployment, yes, at 3.5%, claims near 190,000, Kathy, we all understand that. Should you put more weight on that or more weight on a yield curve that's inverted and PMIs that are sub 50 and have been there now for a series of months?
Yeah, I'm putting more weight on the yield curve, the PMIs, which are good, decent leading indicators, and the fact that we are seeing decelerating inflation. And so, yeah, it was very, very high, but we're starting to see, like in the ECI, et cetera, the ultimate measure of a tightness in a market between supply and demand is price. And what we're seeing in terms of ECI is the price of labor starting to come down. So whether the unemployment rate's 3.5% or 4.5% or whatever, if the price of labor is coming down, that tells us that supply and demand are coming back into balance. So I do think we'll eventually have a recession. Timing is always up in the air, but I'm not putting as much weight on the unemployment rate as I am on the trend in wages.
Equity futures right now down a third of 1%, about 22 minutes away from the opening bell. Mike McKee down in Washington. He'll be in the room with Chairman Powell. Mike joins us now. Morning, Mike.
Good morning, John. Well, the numbers we got this morning sort of lean in the direction of a labor market that is getting looser and is trending in the direction that the Fed would like. ADP payrolls, just 106,000 jobs created, they say, down from 253. However, the odd thing about it is ADP does not put any of the onus on the Fed. They say it's all weather related because of the blizzards in the Midwest and the floods in California. It may be a hint about what happens on Friday with the BLS payroll report, but doesn't tell us anything about what the Fed is going to be thinking today. Because payrolls are a big deal to the Fed. I mean, you go back to Jackson Hole, and you mentioned this the other day, John, when Jay Powell came out with his very tough speech and told the markets that higher interest rates, slower growth, and softer labor market conditions will bring down inflation, but they'll also bring some pain to households and businesses. And as you were saying, there hasn't been a whole lot of pain yet. We have seen inflation come down, but we're not seeing the unemployment rate rise. And so that either tells you that we're heading for a soft landing or that, as Bob Michael was saying, we're going to have problems ahead. And that's going to be kind of the real question out there is what happens ahead. Now, we do get today some new voters on the Fed. Probably won't make a difference because they're nobody's really thinking they'll do anything but 25. But just so you know, some of the hawks have rotated off, Esther George and Loretta Mester and Jim Bullard. Now we have more centrists on there, except for Neil Kashkari, who has really cast himself as a hawk these days. But Lori Logan and Austin Goolsbee voting for the first time. So we'll get an idea maybe of what they're thinking.
Looking forward to that. I imagine Kashkari will put out the blog as well. It was an interesting blog at the start of the month. Mike, stay close. Bob Michael, you usually have a question for Mike McKee to ask in this presser. What is it today?
I think he's supposed to go right at their last summary of economic projections and say, what happens if you're right? And you have unemployment ratcheting up to 4.6%, and core inflation is running at 3.5%. Can you really sit there and do nothing, as your dots indicate, because you'll have failed on both your mandates?
Mike McKee?
That's a good question. I'll put it on my list right after Tom Brady retired again. Do you think he'll stay retired? No, I think you're right, Bob. We're going to get a lot of questions about what the Fed thinks now about what's going to happen, because if they are indeed close to the end of tightening, what is it that would make them move away from the idea of keeping rates higher throughout the year?
Mike McKee, looking forward to your coverage a little bit later. Mike McKee there down in Washington, D.C. Bob, I want to come back to you. We know in this news conference, somebody's going to ask about these easing financial conditions. I guess it's a two-part question. I've explored it all week. One, how do you expect Chairman Powell to address that question? And two, does it make a difference to market pricing? Do his words carry much weight these days?
He's going to be hawkish, and he should be. He can't sit there. And they've raised rates at the fastest pace since 1980. You've got a period ahead where you're going to see what those cumulative and lagged impacts are. You can't have the markets running roughshod ahead of you and rallying like crazy. Will it matter? Absolutely not. I've been out the last 3 months meeting with clients everywhere. Institutional clients, wealth management clients, retail clients, U.S. clients, foreign clients. Not a single one has said to me, oh my gosh, I have too many bonds. What should I do? When should I get out? Every single one has said, how do I get into this bond market? What should I buy? When should I buy? Where should I buy? And we tell them, buy an aggregate bond fund now, get in. Once the Fed is finished, the entire yield curve is going to ratchet lower. regardless of whether they have to come back at year end or not, our view is to look at where bonds are and predict the bond market. I think this summer, once they pause, there's so much money waiting to come in, the entire Treasury yield curve will be 3% from 2 years to 30 years.
Bob, let's pick up on that. You've got the menu of fixed income. They come to you, they want to put money to work. They haven't owned bonds, not for a couple of years, as you've indicated, maybe for 5, perhaps even longer. Sovereigns are at the top of that menu. You've got high yield credit somewhere near the bottom. What do you tell them to buy? Never mind a diverse fixed income fund. I don't want that right now. I want to hear from you where you are on high yield junk credit, which has rallied to start the year and spreads are tighter. What are you telling them?
So we've done great on investment grade. We've owned tons of municipals. We've owned external emerging market debt. We've owned investment grade corporates. We've owned securitized credit. We lengthened duration. We did great. We've stayed away from high yield because our analysis shows us that the peak in high yield credit spreads always comes during a recession. It could be fast, just like the peak in Treasury yields in October happened very quickly, but that's when it happens. So we think high yield is a latter half of 2023 trade. Here's where we've been wrong, where we've looked at how much tightening they've done, how fast they've raised rates, and we thought that period from last rate hike to recession, which is normally about a year, would be compressed to a couple quarters this time. And actually, it looks like it's going the other way, that the accumulated excess savings on all the balance sheets that I talked about is helping to absorb that. But it's not enough for us to get into the high yield market full-fledged.
Kathy, what's enough for you?
Yeah, I would agree with Bob. We've been cautious on high yield, with basically neutral for quite some time. I don't think the spread is wide enough to compensate for the risk and the refinancing risk that we'll start to face in another 6 months to a year down the road, and deterioration as we see in the economy. So, and there's really no reason to really jump at high yield at this stage of the game. There's so many opportunities in the market to earn really good returns. We've been in the same camp of extending duration and adding to high quality bonds, especially investment grade corporates. Why go to high yield if you don't really have to earn good returns?
Kathy Jones, Bob Michael, sticking with us, I'm pleased to say. Equities right now down a third of 1% on the S&P. Coming up, layoffs sweeping across corporate America.
Margin compression has started. The next phase will be defending those margins for corporate America. That most likely means layoffs.
That conversation up next.
On the product may read "Made in the USA," but the sign on the CEO's door often says "Made in India." Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
at the place where layoffs are the most likely catalyst to give Fed confidence inflation will get back to 2%. CapEx intentions will continue to get cut. The layoff piece is usually the last thing to go. We're all getting very impatient in this business cycle. Things are seemingly happening very fast, but for economics and regular folks in America, it tends to take a little bit longer. The tech sector is there.
Layoffs piling up across tech firms. PayPal becoming the latest to join the cost-cutting push, slashing 2,000 jobs. The CEO telling employees, quote, "While we have made substantial progress in right-sizing our cost structure, we have more work to do." Katie Lyons on a story. Hey, Katie.
Hey, John, those 2,000 jobs represent about 7% of PayPal's workforce, and they already had started to lay people off last year. This is part of a broader cost-cutting initiative. They're trying to save $1.3 billion. They're shuttering offices as well to do that. And I know I'm going to sound like a broken record because we've heard different iterations of this story so many times now, but this is an example of a tech company that saw its headcount swell over the course of the pandemic and now has to make really tough decisions to support the bottom line as the top line comes under pressure because of a weaker macroeconomic environment. You can see that evidenced by PayPal's sales growth, which has started to slow down. And there's others examples of this. Just this morning, Match Group said it's going to reduce its workforce by 8%. Workday announced a 3% cut yesterday. We've seen Amazon, Alphabet, Microsoft, Salesforce, a long list of other names in the tech sector as well. And if you listen to Bank of America that published earlier this week, they say that data suggests that some U.S. tech companies are still about 20% too big on average, even after the job cuts we've seen when you compare staffing levels to revenue. But of course, this isn't just limited to the tech sector. C-suites across the board are thinking about headcount. That's evidenced by the number of times the headcount has been mentioned on earnings calls. It was the highest since the financial crisis last year. And so far this earnings season, we've heard another 570-something mentioned, John, and we're only a third of the way through these reports.
And unfortunately, more still to come, I imagine. Katie, thank you. We'll catch up with Katie Lyons around the opening bell. Kathy Jones, is this a problem for tech or a broader problem for all of us?
Well, I think tech is on the leading edge of it, but I think it's a broader problem. You know, it's always a soft landing until it isn't, until it's a hard landing, and that's when the unemployment rate starts to rise. So tech companies are the first to be laying off because they were the biggest hirers during the pandemic. But that ripples through the economy. For every tech worker, there's going to be somebody in the service sector who loses a job, or some percentage of those layoffs will lead to losses in the service sector. And we're seeing, you know, manufacturing sector already seeing those wages start to come down, those orders are down. So it isn't just the tech sector, it will ripple through, I think. It's just a matter of time.
These big job cuts started with Meta, Facebook, a number of months ago. We get Facebook after the close. I'll talk about that name a little bit later with Chris Harvey of Wells Fargo. Equities right now down about a third of 1%. Bob Michael, I wanted to finish on fixed income with you. The Fed's doing QT. They're going to hike some more through the next 12 months. I've got no idea how much. The ECB's in the game as well. QT, rate hikes, maybe as much as 125 basis points plus to come from the ECB. There's an odd one out here, Bob, and I'm wondering whether it's the BOJ who gets set to join the party and what you think that's going to do to global fixed income.
Yeah, that's a really good question, John, because it is the Bank of Japan, and you talked about the developed market central banks. Also, the emerging market central banks have done a ton of tightening, and yet the Bank of Japan sits out there. Last time I was on, we talked about they may have missed an opportunity to widen the bands on yield curve control. They do have inflation. They do have some growth in the economy. They do have a positive immigration policy. What they have in place, to me, looks so outdated, it could only change. What does that mean for the rest of fixed income? It means that markets outside of Japan are less attractive. Right now, if you buy U.S. Government bonds and hedge them back to yen, you're coming out with a negative yield, not like negative relative to where JGBs are, but outright negative. I think if you return to something that looks normal in the Japanese bond market, where the central bank just guides policy around growth and inflation and lets the market price the bond market, that makes that market very attractive. And my concern is, if it's done clumsily, it could lead to a generation of repatriation of all those flows we've seen in the last 20 years come out of Japan into the U.S., European, and emerging markets.
So, Bob, final question then. Can you tell me if that's a challenge or not to your view that the whole of the yield curve in the Treasury market drops down to 3%?
No, right now it's not a challenge. That's a longer term concern. Right now, I don't want to lose sight of the planet is looking for an opportunity to buy bonds. And every backup is going to be bought and will never back up to the level that people actually want to buy.
Bob, you sounded bullish on core fixed income, that's for sure. Busy man to start the year. Kathy Jones, I imagine you're super busy as well. The year of fixed income, we're told, again and again and again. To the two of them, thank you. Equity futures right now down a third of 1%. Coming up the morning calls and later. Do not fight the Fed. That's the message from Morgan Stanley's Mike Wilson, plus Chris Harvey of Wells Fargo. He'll be joining us on the other side of the opening bell.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Away from the open, let's get you some morning calls. First up, Goldman downgrading Hasbro to neutral, expecting delays in the company's buyback plans. Credit Suisse upgrading Foot Locker to outperform, saying sentiment remains overly bearish. And finally, UBS downgrading Snap to neutral, expecting competition to weigh on future growth. That stock down about 12%. Coming up, Meta earnings on deck, plus Morgan Stanley's Mike Wilson calling last month's rally just another bear market trap. That conversation up next. Your opening bell just around the corner.
For parents and anyone out there who still doesn't quite understand, what exactly are kids doing on Roblox?
Kids on Roblox aren't just playing, they're learning, they're hanging out together. When they can't be together in real life, they're hanging out on Roblox. They could be playing hide and go seek. They could be pretending they're running a store or a pizza parlor. They could be making the next big game or adventure. So it's really a wide range of things, and it involves doing things together, pretending you're together.
Everybody's talking about the metaverse as something that's going to happen in the future, but there's an argument to be made that Roblox has already built a metaverse. What do you think?
I think we've started. There's still so much innovation to be done, and there's so much invention to be done in this category that it's mind-boggling.
Why is it that whenever there is like a scare coming along or a pandemic or something, people rush to buy toilet paper? You notice that? People are just, they're stockpiling toilet paper.
It's
Is that
called a hoarding,
Hoarding,
and
okay.
it's one of those things you never want to be without.
When innovation strikes, Bloomberg Technology is there with the news and analysis you need. Every weekday, only on Bloomberg.
This is Bloomberg.
23 seconds away from the opening bow this morning. Good morning and hello February. January, what a month. The S&P 500 up about 6%. The Nasdaq 100 up more than 10. Right now, futures lower, soft and negative down. A third of 1% on the S&P. On the Nasdaq down about a tenth of 1%. There's the opening bow going into the Fed and the economic data today, and Meta after the close. Into the bond market, yields lower by 5 basis points now. Downside surprise on the ADP report. What ADP report? And then you trade on it. I never understand it. Everyone throws cold water on the ADP report, and then we get a move and we trade on it. In the bond market of all places, 345.88. Going into payrolls, softer ADP report. We're still looking for something in and around 200K on payrolls Friday. That's a couple of days away. In the FX market, euro dollar 109.02, positive a third of 1%. What is Eurozone CPI data without German CPI data? We didn't have the German stuff, but apparently the downside surprise on Eurozone CPI is worth something going into an ECB. Still set to hike 50 basis points tomorrow. 109 on that currency pair. On crude, just south of 80, 79 right now. We're positive by about 0.2%. 45 seconds in, we're down a quarter of 1% on the S&P. On the Nasdaq, we're down about a tenth of 1%. One stock to watch at the open, AMD, delivering better than expected results and a robust forecast. The CEO saying this: as we enter 2023, we expect the overall demand environment to remain mixed, with the second half stronger than the first. Kelly Lyons has this one. Hey, Kelly.
Hey, John, stronger than feared for sure. You got a small beat in the quarter they just reported, and that first quarter guidance coming in ahead of expectations. $5.6 billion is what the company is forecasting. That was just ahead of analyst estimates of around $5.56 billion. The average, or one of the low end, was $5 billion. For another chip maker, though, Western Digital, not so lucky. They actually came up short of expectations, really getting hit by PC demand weakness. The thing is, that's an issue for AMD as well. Their PC chip unit saw sales down 51% in the fourth quarter, but it was able to offset that weakness with gains in the lucrative server market. Its data center business posted a 42% jump in sales from a year ago, as AMD has been able to take more market share there from rivals like Intel, which we know, as evidenced by their forecast last week, is really struggling. While you're seeing a stock like Intel, though, struggle broadly, though, semiconductors have been faring very, very well this year, outperforming even the broader rally we have seen in technology. The SOX index is up 15% year to date. It just had its best January since 2001, but we have to keep in mind this is following a 36% decline last year, which was the worst for the sector since 2008, John.
Kelly Lyons, thank you. Kelly, thank you very much. Without a doubt, the quote of the morning so far comes from the Peloton CEO, Barry McCarthy, saying this: we were on the brink of extinction, and that's no longer the case. We've put to bed questions about the viability of the business. Katie Greifeld has more. Hey, Katie.
Hey, John. Back from the brink, indeed. We saw revenue come in at about $793 million. That beat both the street and the company's own estimates. And McCarthy also predicted that Peloton will see positive cash flow by the end of June. So investors are certainly cheering that. But that being said, Peloton, of course, is not out of the woods. Sales are still falling. They're expected to decline 27% year over year this quarter alone to somewhere between $690 million to $715 million. But the good news there is that the midpoint of that range is still well above the average analyst estimate. Back to the shares, though, they are absolutely soaring at the moment, up about 10% just a few minutes into trading. And as you can see, this company has a long history of earnings volatility, those post-earnings moves. This one, though, at least is to the upside, and that's a needed shot in the arm given that this stock is still down about 50% or so over the past year.
Katie, thank you. Another stock with a long history of big earnings day moves, Snap. Snap right now getting hammered, down about 10 or 11%. The social media company forecasting its first ever quarterly revenue decline, expecting headwinds to persist. Mandeep Singh of Bloomberg Intelligence joins us now. Mandeep, have we got a single name problem or an industry problem here?
I think it's more the latter, and the reason I say that is because when you look at Snap's user data or engagement metrics, they look pretty solid. At least, they're not losing market share. But I think overall ad pricing continues to decline simply because advertisers are pulling back, and that's the easiest thing to pull back when you are in a slow growth environment because it's so discretionary, and that's what we're finding with pretty much every vendor, not as much with Alphabet. So I think Google search still has a higher ROI on ad spend, but when you look at social media ad spend, you're going to see a pullback across the board.
Mandeep, thank you. You and I are going to talk more through the week when we get earnings from Alphabet and earnings from Meta as well. That stock is down about 11%. The broader market down 1/3% on the S&P, on the Nasdaq down 0.2%. Beware of the Fed. That's the message from Morgan Stanley's Mike Wilson ahead of today's rate decision. He wrote the following to kick off the week. The recent price action is more a reflection of the seasonal January effect and short covering. Investors seem to have forgotten the cardinal rule. Don't fight the Fed. Perhaps this week will serve as a reminder. Mike, I'm pleased to say, joins us right now. Mike, you've had a series of great quotes already to start 2023. Here's another one. Bear markets are like a hall of mirrors designed to confuse investors and take their money. So can you tell me what on earth that rally was about in January?
Well, good morning, John. Yeah, I mean, I think it's what you know it is. It's, luring people into believing, the world or the reality is different than what it is. And there are a couple things going on. So first of all, the move we had this month is very typical in the month of January, particularly coming off of a difficult year. And we've been very focused in on January of 2001 as a very similar period. We had a, re-rating of the big tech stocks and, the former leaders, and that was due to kind of the tech bubble itself. And I would argue that COVID was almost like Y2K in many ways. We've talked about that many times. And you had the Fed normalizing rates. So you had this big drawdown in the more speculative parts of the market and tech in particular. And then you get into the new year and people think, oh, the worst is over. And then they come back and buy all the stocks that got hammered at the year end on tax loss selling, portfolio markings, et cetera. And you get this big rally in the biggest laggards. And that's exactly what happened in 2001. So we had the best month in the Nasdaq in, I think, 20 years, in this past month. So it's just that it's a January effect snapback. Typically they end on month end, which is yesterday. Now you get the Fed, which is still an important variable in the analysis we've been doing. I don't expect anything surprising from the Fed today, other than the fact that a reminder that they're not cutting rates anytime soon, and they're still doing QT. And sometimes it's just passing of these events. People realize, oh, I guess there really wasn't any new information in there that should change my view on stocks, which should be based on the following, that earnings are disappointing everywhere, okay? This is one of the worst streaks in earnings we've seen in quite a while. And people are now saying, oh, it's better than feared and this, that, and the other. That's like saying a tornado ripped through your house and saying, oh, well, it only knocked out the bedroom. I mean, the earnings are bad. And you need to be honest about that. And you need to say, do I really want to own a company where the margins are degrading like this, and I don't really know where the bottom is yet? I'm just going to trust that it's going to get better. That's not a great investment philosophy in our view, particularly given where valuations are now.
And Mike, I was always told that you can learn two things about incoming information. You can learn something from the incoming information. You can also learn something from the way the market responds to that incoming information. Is there nothing about the way this market has responded to those earnings, which, as you say, have been absolutely terrible? Is there nothing about how this market has responded to them that offers you maybe a bit of a challenge to this bearish view?
Well, absolutely. I mean, no one respects the market price more than I do, John. You know that. If you don't, you're destined to, lose money. But But I would suggest that, remind listeners that that's what happened the last 2 quarters, right? We had, stocks sell off into the quarter, and then the numbers were bad, and then the stocks rallied on that. So, and then of course we made new lows. So I don't think you can conclude anything if you don't have evidence that you think this is actually the trough rate of change. And we don't have that evidence. And in fact, we have analysis that would suggest that the trough rate of change is not here yet, that we have several more quarters of this, further disappointment, and we think that that disappointment could actually accelerate in the first quarter of this year.
Let's pick up on that. We've had earnings from the banks. Tech's still coming in. Can you talk to me about where you think reality might bite on the calendar? You mentioned a period there, Mike. Where do you think reality does bite?
Well, look, for us, as you know, John, it all comes down to profitability. We think that the pandemic and the recession and recovery that ensued led to this, incredible incremental positive operating leverage environment driven by higher inflation. And now inflation is coming down faster than costs are coming down. And that mismatch is leading to significant negative operating leverage. We think investors, at least investors we talk to, and we talk to probably more investors than anybody in the world, we think that that feature is either underappreciated or misunderstood. We also think that that feature is misunderstood by companies, because not only have investors never seen this kind of an environment, but most CEOs have not seen this environment unless they've been a CEO for 30 or 40 years, which that's not many of them. And so I just think that this is a unique period in history. I think people are going to be surprised on the downside here on the profitability, just like they were surprised on the upside. Okay, let's go back 2 years ago when we were the raging bulls on earnings, saying that operating leverage was going to surprise on the upside. Nobody saw it. I mean, in fact, it exceeded our expectations too. But we saw this incredible positive revision story because companies kept underestimating that positive operating leverage. And we think it's the exact opposite now. And it's just going to be a drip, drip, drip until they finally capitulate and say, you know what, we don't know what's going on. Let's just slash the numbers and let's make this our final cut. And we're not there yet.
Mike, do you think that pain's going to be more acute in tech, where some of these massive firms in their current form, shape and size, have never really experienced a cyclical test before? Because as we said previously, the pandemic wasn't that for these companies.
Well, that's right. I don't think it's just tech, though. I mean, the one thing I would say is different this time versus, say, 2001 is that the over-earning, right, was extraordinarily broad. Back then, it was really TMT, and now it's in everything. It's in financials, it's in consumer, it's in industrials, it's in consumer goods and services. I mean, it's all over the place, John. And so one statistic we're very focused on is that 80% of all industry groups in the S&P 500 now have cost of goods sold growth higher than revenue growth. That's an incredible statistic that I think people this is not a couple of companies, okay? This is basically across the entire S&P 500.
So the test is still ahead. The lows you think are in our future. Mike, can I ask you, if there's something you had to buy right now, if you were told you've got to buy something in this equity market, Mike, where would you find it? What would it be?
Well, I mean, we've been sticking with our view that you want to own kind of defensively oriented companies, but those have gotten expensive too, and we're starting to see even some of those companies in the staples, for example, that are struggling with this negative operating leverage problem. I think healthcare is still the one that kind of sticks out. It had a good year last year. It kind of gave back some of that early this year as we saw a rotation back into the laggers. But I like healthcare for the two reasons that they didn't have a big pull forward in demand during the pandemic. They still have organic growth. In fact, you could argue that there's probably pent-up demand for some healthcare services. And so that's an area we continue to like a lot, some of the HMOs and areas like that.
Mike, this was great. It's always fantastic to catch up with you, buddy. As always, Mike Wilson there of Morgan Stanley, not constructive on what we're seeing come in at all and throwing cold water on a big rally to start the year. Right now, we kick off February a little bit lower. We're down 1/4% on the S&P. On the Nasdaq, we're down 0.2%. Coming up, more economic data to come before Chair Powell takes the podium.
The effects of 400 basis points of tightening are going to start filtering through the economy. They're already showing up in manufacturing and housing.
Plus, we'll speak with Chris Harvey of Wells Fargo as Meta kicks off earnings for big tech this week.
growth forecasts are increasing and inflation is falling, will the European Central Bank make its fifth rate hike in a row? How high do rates need to go? Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference.
The central banks, and certainly the ECB is pushing this line, have got much more wood to chop. They've got much further to go.
Coverage begins Thursday, only on Bloomberg, your global business authority.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
The top names in business are on Bloomberg.
More and more people are frightened of the realities of today, and that's manifesting in so many areas. Why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? I'm not here to suggest it's going to be rosy in 2023, but what I'm saying for long-term investing, it's a better environment for long-term investing today than it was 2 years ago.
Nobody covers business like Bloomberg, your global business authority.
The U.S. economy is still in pretty good shape. Household balance sheets are healthy. Job growth is still very strong. But, we do think that the effects of, 400 basis points of tightening are going to start filtering through the economy. They're already showing up in manufacturing and housing.
Economic data breaking just moments ago. Here's Mike McKee with more.
Well, John, it passes for good news these days, I guess. No real change in the S&P PMI for manufacturing in the United States. Goes up to 46.9 from 46.8. Statistically insignificant, but does show that maybe a floor is in on the collapse in manufacturing as the economy slows. The big numbers will come at the top of the hour with ISM. But this has been sort of the theme around the world today as we saw France improve. The German economy had a bigger decline, but the Eurozone as a whole stays in one place. Unfortunately, your United Kingdom down a bit as well, John. But overall, the manufacturing numbers are not falling like they were. And so maybe this is the kind of worst of it. We'll have to see. We'll get some more data from the ISM, too, some more detailed data on new orders and employment to give us a better picture of what it looks like.
Thanks, Mike. Get that at the top of the hour. Everyone keeps taking a dig about what's happening in the UK. I don't take it personally. About 20 minutes into the session, equities down 0.2%. Mike Wilson of Morgan Stanley pouring cold water on last month's rally. We caught up with him just moments ago.
Sometimes it's just passing of these events. People realize, oh, I guess there really wasn't any new information in there that should change my view on stocks, which should be based on the following, that earnings are disappointing everywhere, okay? This is one of the worst streaks in earnings we've seen in quite a while. And people are now saying, oh, it's better than feared and this, that, and the other. That's like saying a tornado ripped through your house and saying, oh, well, it only knocked out the bedroom. I mean, the earnings are bad, and you need to be honest about that.
Chris Harvey of Wells Fargo seeing a little bit of upside into year-end, saying the following: we maintain our 4,200 year-end S&P target, but expect near-term chop and see more upside in small and mid-caps. Chris, I'm pleased to say, joins us right now. Chris, let's go through some of the comments from your peers, and thanks for joining us, mate, as always. Mike Wilson thinks this is a bear trap. Marko Kolanovic says fade the year-to-date rally. Do you agree?
What do I agree with? I agree that I'm surprised at the market strength. Is it a bear trap? No, I don't think it's a bear trap, right? If there's a lot of talk about the early 2000s and this being very similar, and there are similarities, but the one big difference is you don't have the same systemic risk today that you had back then. Back then, you had WorldCom, you had Quest, you had a number of utilities where they just over-leveraged, they shut down the credit markets, balance sheets were upside down, and that just didn't work out. But when you look at the consumer, when you look at corporations, balance sheets are much better, the systemic risk isn't as high. We're not big fans of large cap at this point in time. We think there's a little bit more upside, but really the opportunity, similar to the early 2000s, is in the mid and small cap space. So things aren't great. Obviously, we're late in the cycle. Numbers are coming down. Margins are getting compressed. You have to be very careful. But this is not the beginning of the end.
In a similar way, though, to back in that period, is there a challenge to leadership? Are you expecting leadership to come from somewhere else? Because I think ultimately that's where Mike is coming from, Chris. Do you come from the same place?
Yeah, one area we've been looking at for a change of leadership is energy. Energy might be that. The issue with energy, it's just a smaller component of the S&P 500. So can it really drag things along? You know, we have two thoughts. One, we do think we're going back into a more growthy market. But if you're looking for sector leadership, you know, if you look at what's happening in the energy space, some of the policies are going to keep supply constrained. If you look at what the energy companies have done, they've really focused on the balance sheet. They've delevered. They've become much more shareholder friendly with buybacks, with payouts. And at the end of the day, we think the commodity is going to make higher lows and higher highs because some of the issues. So can you have leadership change? Sure. And I think you will. But at the end of the day, I think there's much more value in mid and small cap, especially mid cap growth. I think as we move up the capitalization, it becomes more idiosyncratic, and you have to play it that way. It's a bunch of stocks. It's not a stock market. And what we don't think, one of the things that we want to focus on, and one of the things we want to emphasize about earnings is we think there was a ton of fear mongering coming into this earnings season. So you've got expectations too low. Numbers are going to come down. Numbers are coming down. Margins are going to be compressed. They are, but not to the degree that you've seen. And things are holding up better than feared. And one thing that we're really scratching our head about, we're not sure what that signal means, is when companies are missing, they're not getting penalized. And that market reaction is something we're highly focused on. Again, we're not sure what it means, but maybe in some cases with some stocks, there's just too much fear and there's too much pessimism at this point in time.
Well, Chris, it's one of two things, isn't it? It's complacency or exhaustion. Are you leaning towards the latter, not the former?
Yeah, I think that's fair. There's what we've seen is obviously the short covering rally has been quite aggressive. We have a short portfolio that we look at that we some of our peers have put together. And at one point, I don't know if it's still up over 20%, but it was up over 20% during the month. That's telling us that there's a lot of very nervous hands. The other thing is it's true that people were more pessimistic coming into this year. Right, so there's a little bit of exhaustion of selling from the end of the year to the beginning of this year. But more importantly, right, there's this phrase, don't fight the Fed. But the question is the market leading the Fed or is the Fed leading the market? And we're beginning to get some indication that the market is leading the Fed. We're starting to see some separation between 2 years and Fed funds. You've obviously seen a very different picture than what the Fed has said in the futures markets. But we're beginning to look at the data. We're beginning to look at the market, realizing the market's a better forward discounting mechanism than the Fed. And the data is beginning to really indicate that inflation is coming down, not just on goods, not just at housing at the margin, but also on jobs. And that's incredibly important to the Fed. So that's really something to watch out for. And that's something that's very different.
Chris, good to chat with you. As always, Chris Harvey of Wells Fargo with a, relatively speaking, more constructive view on this equity market compared to, say, Mike Wilson and Morgan Stanley, and both with strong arguments backing up their views on this market. Chris mentioned that inversion, the 2-year versus where the Fed is at. The Fed's going to be pushing 5% in the next couple of meetings, potentially. The 2-year right now, 4.20. The 10-year at about 3.48. We had some breaking news in the last couple of minutes. Let's get to that down in Washington. Here's Anne-Marie.
Hi, John. Yeah, that's right. What we know now is that the Department of Justice is at the president's beach house in Rehoboth, Delaware. And this is the statement from his personal attorney. Today, with the president's full support and cooperation, the DOJ is conducting a planned search of his home in Rehoboth, Delaware. Under DOJ's standard procedures in the interest of operational security integrity, it sought to do this work without advance public notice. But Jonathan, this just goes into more of the drip, drip, drip of the documents and this potential political headache that's widening for the president.
Getting worse, not better. You wonder what it means for his candidacy for the next election, that's for sure. AMH Anne-Marie down in Washington, thank you. On top of that story through the day, down in the nation's capital. Up next, your trading diary from New York. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
26 minutes into the session, just like that, unchanged on the S&P, on the NASDAQ as well, going into the Fed. That's the price action. Here's the trading diary, top of the hour, ISM numbers, look out for that with Guy Johnson and Alex Steele here in New York. A Fed rate decision at 2 p.m. Eastern, followed by a Chatham Town News Conference. President Biden, Speaker McCarthy, meeting at 3:15. Rate decisions from the ECB, the BOE, coming up on Thursday. Meta reporting after the bow before results from Apple, Google, Amazon on Thursday. And finally, it's Jobs Day in America to round out the week. Special coverage on the Fed a little bit later. Richard Clarida, Priya Misra, Diane Swamp, Greg Davis. Fantastic lineup. Do not miss it. I'll see you a little bit later this afternoon.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware. And that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Countdown to the Close.
Welcome to Bloomberg Crypto.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why he may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake.
right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world they look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation was exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price, before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown. and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, Google in the morning, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that he believes broadband is something that can transform a community and should be considered a public good.
One of the first communities to come on in the United States with full-on gigabit service was Chattanooga, Tennessee. Now, they're a bigger city, but they're a city that was economically in a downturn. In the last 15 years, the city of Chattanooga has turned around in an amazing way. It's a nexus for young people to move to. It's a place where technology happens.
It's not just about logging on to Zoom, to connect with your colleagues who might be in New York City. It's also your ability as a small business, operating in the town of Nevada City or wherever it may be to, quickly upload your payroll documents or something onto the cloud, or to quickly, swipe a customer's credit card. There's just some really basic business functions and mechanics that I think people in big cities really take for granted, and that are just going to be a much bigger challenge for small business owners in rural areas.
Historically, the marginalized people, you call them as untouchables or Dalits, they have been kept away from the center of the knowledge. Once you are born into a caste, it is very difficult for you to grow beyond that. You are stuck in that identity. Education is the best way of liberating them. So that's how I chose to work in education sector. The kind of education that we are giving to the marginalized people is going to change not just the fate of these communities in Telangana, but it is going to be the source of inspiration, source of hope for all the marginalized in this country.
Greatest blight in India is the system of caste.
For generations of Indians, the social code known as the caste system has defined how people earn a living and whom they marry. Although outlawed 7 decades ago, castes remain a significant factor in deciding everything, from family ties and cultural traditions to educational and economic opportunities. Dalits, people who are on the lowest rung of the caste system, constitute almost 1/5 of India's population of 1.3 billion. Not able to afford the high tuition of private schools, many are forced to attend government-funded institutions, which in the past have suffered from poor infrastructure, lower education standards, and high student-to-teacher ratios. But Dr. Praveen Kumar is trying to change that.
I am currently working as head of Telangana Social Welfare Residential Schools. So totally above 400 schools I manage. These are all residential schools for the students who are historically marginalized but talented and then poor.
My friend also
Of them, 60% are girls and then 40% are boys, because girls are more marginalized among the marginalized. Their voices are always suppressed. My approach to improve the conditions in the schools has been put your eyes and ears on the ground always. Talk to the parents, talk to the teachers, talk to the students, stay in the schools and then understand their problems, their challenges, both in classrooms and then the corridors and the dorms. Then go to the dining halls and see what kind of food they are eating, and then go to their homes and then what kind of food they are getting and what kind of challenges the parents have. Very good. 9th class. One of the important changes that I brought in after I took over was to complete the transformation of mother tongue to English medium, because English medium, as I said, English is the language of emancipation. A language that connects you to the whole body of knowledge in the world. So we had to train a lot of teachers.
refer to the dictionary also, okay, and find out the new meanings. As well as you're going to describe about. Hey, Richita, how are you? Hi, Sindhu. Fine, thank you. And how about you? I'm fine too. It's been a long time.
Identity is extremely important. There is a scientific evidence to prove that your sense of identity is extremely crucial to your growth as a successful human being in your life. If you accept an identity which is very humiliating, which reminds you of very painful past, I think that identity will not help you to grow. I'm not saying that you should forget your past. I'm not saying that, but that should not be in the bubble in which you must live always. Sweros is an alternative identity. S stands for state, W stands for welfare, Aero, SW and then Aero is Swero. So the idea is your dreams have to be skybound. So that is what we are trying to achieve by changing the identities. Like, you say, I'm a Swero and I aim to be a doctor. I am a Swero, I aim to be a top-notch engineer. I am a Swero, I aim to be a top bureaucrat of this country. I'm a Swero, I want to be a very good actor or, a musician in this world. So these are the positive images that are associated with the identity. Just to give an example to you, in 2012, in our institution, we used to produce about 6 doctors per year. But because of our, this self-liberating ideology of Sveroism, we have, this year, we have produced about 189 doctors. This is phenomenal for any poorest of the poor people. You know how difficult it is to get into a medical colleges in this country. So, but today, because of this ideology, the students have been able to achieve this, feat. Pujita has been a farm laborer, and her parents themselves are agricultural laborers. And then this girl used to sell vegetables, but thanks to the residential education institutions, she came to the Gaulidoddi campus and then she toiled very hard for 1 year, despite many problems. And today, I'm so happy to share with you that she has joined one of the prestigious medical colleges in the state of Telangana, Usmania Medical College, and then in future, she hopes to be a gynecologist. So this is the journey our children are hoping for. Similarly, the Mount Everest expedition. Mount Everest expedition, we are very fortunate enough to place the youngest ever female in the history of this world on the peak of Mount Everest. How did this happen? It's all because of an ideology that helps you to liberate yourself. We brought a lot of extracurricular activities and most of them got institutionalized now. So for example, music. Similarly, the games. We have so many coaching academy. We have boxing academy, we have wrestling academy, we have handball academy. So we have, kabaddi, the traditional Indian sport. We have golf. We have introduced the golf also. Like golf is generally played by so-called rich people, but today even poorest of the poor people also are being trained in golf in our schools. Wow. So our intention has been to give all 360 degrees, type of opportunities to the students, so that whoever is interested in whatever activity, they can go and then do it. Break the barriers, break the fence, at least mentally, because poor people have been programmed to be victims, programmed to be subjugated, programmed to be on the margins, always, programmed to feel inferior. We wanted to change all that. There are certain games which are exclusive to rich people. There are certain languages which are exclusive to middle class and upper middle class in this country. To put it in one word, the sole aim of introducing all these co-curricular activities is to break the stereotypes which are recklessly imposed on these people.
Their stereotypes Dr. Kumar knows all too well. Born a Dalit, his grandparents were labourers and access to the village well was restricted. Dr. Kumar credits his parents' belief in the power of education with helping him realise his aspirations. He went on to join the Indian Police Service, attended Harvard University, and then began pursuing educational reforms back home.
I attribute whatever I am today, it's to my mother primarily. They educated me in the village, although there were no good schools. So then I stayed in social welfare hostels, the hostels which are managed by government for the poorest of the poor kids. I passed with reasonably good grades. Then I went to university and then I faced worst form of discrimination in the universities. Like there were, in those days I'm talking about, so the bathrooms and the toilets were exclusively meant for scheduled castes and scheduled tribes. We used to fight discrimination on one hand and then again, try to excel in academics, day in and day out. So that's how I came to education, because I deeply believe that education is the only important weapon that can really, place the poorest of the poor people from a very victimhood orbit to a prosperous orbit. I think in future, this is going to be a game changer for the marginalized in this country.
If you look at a thermal image of a city and then compare that to a map of vegetation, you'll find that where there's greenery, the temperature is lower. That's because things like asphalt, concrete, and shingled roofs absorb more heat from the sun than trees. This is the urban heat island effect, and it accounts for higher temperatures in cities, often by several degrees compared with their surroundings. It's becoming a huge risk to human health as growing urban populations exacerbate the heating effects of climate change. Heat waves kill more people than any other extreme weather event, more than tornadoes, hurricanes, and even floods. That's why urban heat island mitigation strategies are being studied in Singapore by a group of researchers. The government-backed project called Cooling Singapore is now in the process of combining everything they've learned to create a digital tool that can help cities all over the world, starting with Singapore. In Singapore, close to the equator, temperatures regularly rise above 32 degrees Celsius or 90 degrees Fahrenheit. And the city structures only make it worse.
And that is also the case for Singapore, which is basically a concrete jungle, more urbanized, more developed city. And even in Singapore, what you have is a situation whereby there's a temperature difference of 7 degrees Celsius between the more urbanized and the more rural areas.
The government has taken drastic steps to keep temperatures down. This is Gardens by the Bay, an award-winning park, and inside this greenhouse is a pleasant 24 degrees. That's because the dome, along with 24 nearby towers full of thousands of people, is chilled by what's probably the world's largest underground district cooling system. It uses a large central plant that cools water and then pipes it into banks, residential towers, an exhibition centre, shopping malls, and the city's iconic Marina Bay Sands hotel and casino complex.
So one of the biggest perks of using this system for the buildings is that they can save 40% in terms of electricity usage compared to your traditional air conditioners.
And with Singapore relying on natural gas for most of its power, this new system means emission savings equivalent to removing 10,000 cars from the city's roads. That has big implications for the rest of the world. If things stay as they are, more than a third of the world's electricity could end up being used to cool buildings and vehicles by 2050.
As the world gets hotter, gets warmer, there is a greater need for air conditioning and as well as refrigerators, for instance. And the more people are buying these household appliances, the more energy usage they use, and they release heat more, and that then exacerbates climate change.
It's a vicious circle. And so since 2017, researchers at Cooling Singapore have been identifying design solutions that reduce our need for so much cool air in the first place.
One thing many cities have in common, and that's the importance of vegetation. That's a very important measure to mitigate the urban heat because of the shading effect, of course, and the psychological effects of the vegetation, and also because of the possible evaporative cooling effect of the vegetation. Vegetation can be, of course, on the ground floor in form of trees and shrubs, and you can walk under them. This is the so-called canopy layer that the vegetation forms above us. But vegetation can also go up the facades of buildings, and it can go to the roof of the buildings.
Luckily, Singapore has been striving for the garden city feel for quite some time. It was a vision initially introduced by then Prime Minister Lee Kuan Yew in 1967 to make life more pleasant for people. And today, Singapore is one of the world's greenest cities in terms of urban vegetation. Kampung Admiralty, a community centre that contains health facilities and social spaces, now provides more green space than the plot of land it was originally built on. It's topped by a roofscape of staggered terraces covered in local plants, functions as a community park. And a village green in the centre that contains farm plots for residents to tend to. Park Royal on Pickering was designed as a hotel in a garden that doubled the green growing potential of its site. There's now 15,000 metres of sky gardens, reflecting pools, waterfalls, planter terraces and green walls. And the government has big plans as well.
Singapore actually has a plan to plant 1 million trees and add more green spaces over the next 10 years. It is actually a mix of wanting to reduce the urban heat island effect, but on the other hand is also to get the people to be more connected to nature.
But it's not enough. The city-state has still been warming twice as quickly as the world average over the past 6 decades. That's why Cooling Singapore has developed a catalogue of other potential heat mitigation measures.
When you try to mitigate the urban heat island effect in a city or in any building, in a village as well, the first place to start is by shading of the windows. You have to keep areas clear so that the wind can move through it. Water of a certain depth can act as a very good thermal buffer. If you have to construct heavy buildings such as high-rises, at least you can make the surface, the facade, less heavy, and you can protect it from direct sun penetration. You have to make sure that no combustion engines will be in the city in the middle, in the medium to long-term range. So ideally, the electricity production is outside of the city, and you bring just the clean electricity into the city. You can at least minimize the use of energy in the city, and you can start to slowly convert the roofs, the facades of the city into production areas for renewable energy. In Singapore, unfortunately, this is a limited option, but in the long run, it could produce up to 20-25% of the energy, of the electricity needed in Singapore if all the roofs and the areas in the buildings, on the facades would be used to do that.
With so many different ideas, Cooling Singapore is also designing a virtual model of the city to test them out. It's called a Digital Urban Climate Twin, or DUCT, that will calculate how each element of the city's design will impact the urban heat island effect.
That means we model not only the geometry of the buildings digitally, but also we model the transportation, the insolation, the temperature, the radiation coming from the sun, the weather, the local climate, the even very, very microclimate of the city, the water, the movement of people in the city. We can invent scenarios, we can design scenarios, test them before we actually build them, and if they test very well and we are sure that they will function, then we can start to build them and put them into reality.
Singapore will be using this new tool to figure out which actions it should take next. And the model can be applied to any city, whether it needs to keep heat out or keep heat in, which will ultimately save energy, slow climate change, and improve our quality of life.
So this is something that Singapore will be able to export, maybe even together with its city development systems that it already has. Singapore is one of the very few cities in the world that really combine this scientific approach with a very well-established urban redesign and urban design approach. Through its agencies and the combination of its agencies, it has achieved a lot in the past. If it keeps following the scientific path and the combination with the other knowledge in the city already, we think that it will be a very comfortable and very livable city in the future, even more than today.